We've wiped away some of the post-election euphoria. People are tamping that down.
Investors globally have got to take more balance. That probably means lightening up on US exposure and broadening out to the rest of the world.
The administration has greater tolerance for a move lower in the market and even a full slowdown in the economy.
It's going to seem loud. It's going to be a lot in the headline news. But for the long run, we will get through this.
There's this really negative narrative around tariffs. I promise you it'll change as we get into the summer months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday on a two-day winning streak, the biggest two-day rally of the year so far, with the Fed's two-day meeting kicking off in Washington later on this morning. Attention turning to Europe as President Trump is set to hold a call with his Russian counterpart Vladimir Putin, pushing for a 30-day ceasefire, just as German lawmakers are in the process of voting on a bill that could unlock hundreds of billions of debt-fueled spending. That spending, a key pillar of the Europe trade. The latest Bank of America fund manager survey capturing the biggest allocation to European stocks since July 2021 and the biggest drop in US equity allocation ever. They're calling that this morning, Lisa, the bull crash.
And right now there is this question of how far it can continue. And I'm really glad that you brought up this idea of the event risk truly being in Europe this morning. You have the 1-2 punch of both the potential for the Ukraine-Russia war to end, as well as spending to get past the Bundestag, the lower house of German parliament. If they don't get done, do you get a reversal of what we've seen? If they do get done, do you just have a turbocharged move into Europe and away from the United States?
We've been on this story now for a number of months. The actions of the President of the United States pushing the Europeans to do things that might be good for them.
It might be good for them as we see what's going on in Germany and potentially also Europeans talking about things like deregulation. When it comes to, though, this potential of ending a war on European soil, Caroline Leavitt, the president's press secretary yesterday, said we are on the 10th yard line of peace. Coming out of this meeting is going to be incredibly important. The Kremlin says it's going to begin potentially as soon as 9 a.m. this morning. Two things to watch out for. Maybe the two will talk about a summit when they meet in person and whether or not we could see business ties, maybe some sanctions lifted or other sort of business ties come back into the fore.
Which a few months ago was absolutely unthinkable. Now, you may disagree with the President of the United States on his strategy to get Russia to come to the table and secure some kind of peace agreement in Ukraine. But the euro doesn't have feelings. The euro right now is close to 110, and the euro is close to 110 because of that, not just because of the spending effort in Germany.
This was one of the bull cases for Europe coming into this year, was the potential for the Ukraine-Russia war to end. Now we seem to be getting closer to that, and it's one of the prongs. Mark Rutte, in a conversation with you from NATO, talking about the likelihood of normalization of ties with Russia. Seems like it's a far way off for that in Europe. That said, it really raises the question, are there a lot of things that could go right or not?
He said it's not there yet, but he did say step by step. And if the war were to end and relations were to be normalized, this could be a potential outcome.
That call is set to take place a little bit later on this morning. Once we get headlines from it, we'll share them with you. Equity futures right now in the S&P just a little bit softer. We're down by 0.2%. Coming up this hour, Tchir of Academy Securities in the recession camp, Elyas Galou of Bank of America on a cautious global fund manager survey, and Kit Jiggs of SocGen looking for the big euro rally to continue. We begin this hour with stock steady as the Fed kicks off a two-day meeting. Tchir of Academy Securities writing, I don't see the Fed acting in a big enough way to offset the risk that I see. The convergence of so many policies seems to risk a recession before any probability of seeing the benefits. Pete joins us now for more. Pete, good morning.
Makes me sound so bearish.
Got to say, you sound incredibly bearish. Are you saying you're not?
No, I actually am. I think one thing is, even the prior discussion, I think a big part of the change is we are trading capital flows, for trade benefits, right? So we're going after trade. I think we're seeing capital outflows, and it's been a perfect, mix for taking capital outside of the U.S. All of a sudden, you have yields up in Japan, you have yields up in Germany, so you can actually get some return on that side. And when you look at equity valuations, all these other markets had lower valuations. So I think one of the big problems with our strategy so far has, rather than having people come to the table begging for mercy, it's actually pulled money out of the system. It's made people rethink things, and they're not rethinking things in a way that really involves the U.S. I think people are trying to rethink things away from the U.S., and that's the negative.
That was not the objective. These are unintended consequences. And for the market, the consensus view was that some of these policies would lead to dollar strength. They've led to dollar weakness. That speaks to the capital flow story. Do you see this turning around anytime soon?
Yesterday was the first day we really went the full day without any big tariff headlines. People have seemed to maybe there is a Trump put. Maybe you realize, hey, bashing on tariffs every single day, bashing our allies is not a good strategy. And you keep looking at it. We've been searching for where's all this excess capacity. So one, there isn't a ton of excess capacity. So if we just make things more expensive coming in here, that will flow through a little bit. And then you have China. China's the one with excess capacity. Their pricing is so cheap that 20% tariffs that we've added don't really make them uncompetitive. So I think we have to rethink this and do some sort of holistic strategy that has a 1 to sort of 3 year plan. How do we build steel plants in the U.S.? There's so many things that need to be done to make this effective, and we just dumped everything on day one, and it's been a mess.
There's shifts in capital flows that are easier to see than others. One of them is just looking at the euro versus the dollar. One of them is looking at stock allocations shifting to the euro region rather than the U.S. You've raised a point about boycotts or basically withdrawing from American brands overseas. Are we seeing any signs of that other than, say, Tesla, which is somewhat idiosyncratic?
It's hard to tell, but I think you are seeing a little bit of evidence that people are, okay, at the margin, shifting away from American brands. And I think American brands represented so many positive things. And I really think the administration is at risk that there were so many intangible benefits from what the U.S. does, from the presence that we had, kind of this benevolent superpower. And as that goes away, I think we lose some of the reputation, and that hurts. And unfortunately, too, I think the way we've thrown out all these tariffs, even if you didn't like China, you kind of have to come knocking at China's door and say, hey, maybe we should be doing business.
Is there a risk that people are getting over their skis with all this pessimism? That if you take a look at the actual policies, we haven't seen the more positive sides of things. Not all of the people are in their seats yet in terms of executing these. We haven't been through April 2nd. And if you actually look at growth, it isn't that bad. Even the airlines, which everyone uses the example of a slowdown, are still booking at pretty healthy rates. What's that risk?
So I think the risk is where we're headed. I think the things that DOGE has been doing, so one, we're cutting some spending. That does flow through the economy. I think you're seeing that it's very difficult to get jobs for those people who are getting left behind. But then more importantly to me is there's so much uncertainty, it's putting plans on hold. So, normally you like to do things that pull demand and, hiring forward. If anything, we're pushing it further away, right? There's no one that we talk to really that's saying, well, I have to bring my construction back to the U.S. from, say, Canada or Mexico because I don't know how long these tariffs last. They might only last a month. That would be silly for me. And it's going to take months and months, if not years, to do this. So I think there's a lot of hiring on, freeze. So unless the Fed does something tomorrow, which they might, but I don't think they will, when we see a real change in messaging, I think we resume the sell-off, and I think we're going to head to bear market territory down at least 20%.
Are you saying that the tariff uncertainty can tip the U.S. into recession, just that alone?
I think that combination of the spending cuts that we're doing, the firing in that sector, it was already, I think, I look at the quits rate, right? The job market wasn't that great. I think the official data tends to get overstated in January, February because they're still miscalculating a bunch of the seasonals. So if we tip over into weak employment, people on hold, no one quite understanding the cost of goods, which I think will go up to some degree. Yeah, I think we tip into recession far faster than people think, and maybe we're already at that sort of stage.
We're at an inflection point this morning. You have a bunch of generals you consult with at the firm. What do they make going into this phone call between Trump and Putin?
So one, I'll take a step back. I think one thing they were all very positive on was the actions in the Middle East to clear up shipping. I think that's the right sort of thing. It puts pressure. I think we've argued under the Biden administration that we lost deterrence as a tool. And to get deterrence, you actually have to be aggressive periodically. You have to put some fear. So that I think we were very positive on. I think we're all trying to figure out what exactly the end game is with Russia and Ukraine. I think this is an opportunity maybe for the president to come out looking good. I think if Putin offers a really bad deal and the president accepts it, again, I think that will cause this further divide where you see more of this. Any sort of peace deal, though, we really think was always going to benefit Germany and Poland. Poland is going to continue to be the big winner in this whole realignment of Europe. So continue to be positive there for stocks. Whether or not there is a deal right now, we're headed that direction. And I think a bad deal, though, would really push people away from the U.S. again, unfortunately.
Hold up, Pete. You see a situation where U.S. equities could be in a bear market, down 20%. And German equities could stay this high, up 20%.
Yeah, I think, one, you look at valuations, they're still somewhat cheap. People are pulling their money back to their own home base. They are doing spending. They're doing things that are going to be clearly constructive for their businesses. I think they do have some excess capacity, right? VW is trying to figure out, no one wants to buy a VW EV, supposedly. What do we do with that? Okay, can we make military equipment? And I think that's going to be interesting. And normally that sort of spending would fall heavily into the U.S., right? Germany would be spending a lot of their money on U.S. equipment, U.S. things. They feel very reluctant to do that, given the current tone. That could change, but so long as that's going, yeah, we're getting the separation. You get those valuations picking up there.
Does the groupthink not concern you? over in Europe right now, that overwhelmingly there is a huge consensus celebrating Germany rearming. Does that not concern you?
In which I don't think it's a bad thing for people to have their own ability to defend themselves. What I do think, though, is Trump's been pushing for this, 2.5%, 3%, whatever spending required he wants. But I think that was all done in the way that, well, we're still going to be the big person in NATO. We'll still tell NATO what to do. And I think the spending is now, okay, we're actually going to spend this, but maybe we don't need the same U.S.
I just want to approach this logically, because at the one point earlier this year, we were confident that for European equities, it was a good story of the United States push for a quick peace agreement. Part of that story's happened. But Germany rearming, Europe spending on defence, doesn't scream they're pushing for a quick peace deal. That tells me they're pushing for something very different to what President Trump is pushing for.
Well, I think this all comes down to what sort of deal is put in place, right? I think the fear is that if, and I'm probably on the European side, I think most of our generals would be, that if you do not put some sort of protection in place, this is just a temporary rearming for Putin to go back in and take a bigger bite. And I think that's the big disconnect right now is, I think when we were looking at this and we figured we'd get some sort of peace, we did not think it would be easy. We do believe that Ukraine's going to have to give up some land. We do think that they will get a lot of money from this. The whole key is, like, whether it's security agreement, how do you stop Russia from just rearming and coming back in? And that's, I think, what Europe's preparing for.
Is German rearmament basically Europe trying to set deterrence with Russia?
Yes, I think that's
Even
exactly.
if they're willing to have gas deals once again?
They will try and do both. I think all sides, again, it's like this going to be this mad panic where everyone's trying to rearm themselves.
Something about it, Pete, doesn't add up. Something about it doesn't add up.
Well, none of this has added up when we look at what the U.S. was doing with Iran, right? We were allowing Iranian oil to go through. Russia continues to sell your oil into and natural gas into Europe, right? Everyone is so scared about energy, and that's the crazy thing, right? If you went back 5 years ago, everyone was about green energy, green energy, green energy, and even the U.S., everyone energy self-sufficient. We realize all it takes is one oil price shock to realize we are not that energy and self-sufficient. Inflation's scary. So I do think I love the energy market. Again, my strategy for the U.S., where I do like the U.S., is I'm continuing to invest in anything that national production and for national security's sake. So anything that has a security element, I do think we are going to see more and more production of that. I think things like chips are very important, medical equipment, those things are actually going to be really part of what gets driven by this. So you'll see some growth. That's where I'm headed. I'd like to see more done, though, by actual legislation. The executive order thing, I think, is not going to work particularly well. If it takes 4 or 5 years to build a plant, no one's sitting there saying, based on some executive orders that may be turned over in 4 years or may be turned over in 2 months, I'm not investing.
Pete, it's good to see you. Bearish, very bearish US equities. Peter Tchir there of Academy Securities. I'm saying that for Pete, but Pete basically said it too. Looking potentially for a bear market in US equities at a time where European equities might be as high as 20%.
Yeah,
up 20% by the end of the year.
Talking about the flows really reversing, and the only thing that could really stave that off would be more policy certainty from one or the other, either the Fed cutting rates this week or potentially for the White House to back away from some of the plans.
Equity futures a little bit softer this morning on the S&P 500 with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Trump, is set to speak with Russian President Vladimir Putin today. Interfax reporting that the call will kick off at 9 a.m. Eastern. The U.S. is pressing for Russia to agree to a 30-day ceasefire with Ukraine. Trump has hinted that the U.S. and Russia are already discussing how to divide assets in Ukraine. Elsewhere, Israel launched a wave of airstrikes across the Gaza Strip today in response to what Prime Minister Benjamin Netanyahu says is Hamas's refusal to release Israeli hostages. Gaza health officials say at least 44 Palestinians have been killed. The move ends a nearly 2-month ceasefire that had paused 15 months of fighting. A proposed tie-up between Capital One and Discover Financial Services may be in jeopardy. The DOJ has expressed concern about the $35 billion merger, saying it would harm competition, but did not make a final decision. That merger is awaiting approval from the Federal Reserve and the Office of the Comptroller of the Currency. And that's your brief, John.
Danny, thank you. I remember the days not so long ago when we all thought it would be easy to make deals happen.
I had the same reaction when I saw this story. I was thinking, really, a financial deal that could get stymied because of concerns about the subprime lending market? Think about tables turned in terms of expectations.
Not what we expected, put it that way. Up next on the program, all options on the table.
The president would tell you that all options are always on the table. April 2nd day is a big day for the country, as the president has said. Reciprocal tariffs will go into effect.
That conversation up next with Ed Mills of Raymond James, live from New York City this morning. Good morning. Equity futures on the S&P 500 just a little bit softer here. We're down by 0.4% on the S&P. Some breaking news just moments ago. Later on this morning, there will be a call between the two leaders of Russia and the United States, President Trump and President Putin. This coming from our team here at Bloomberg, that Putin is said to want all arms to Ukraine, demanding a suspension of all weapons deliveries to Ukraine during a ceasefire proposed by Donald Trump later on this morning.
Not surprised by this headline. Putin is certainly going to come into this negotiation with really high demands in order to get to that 30-day cessation of fighting. One of them seems to be he wants all arms to Ukraine halted. Basically, the U.S. has been the ones backstopping and arming this country. And for, I think, Putin to get to a yes on a 30-day ceasefire, he's not going to want to see that military equipment come into the country. This is going to be incredibly difficult for Zelensky to sign off on, as well as European allies.
Plenty of coverage on this story throughout this morning for you. We'll hit that a little bit later. Under surveillance this morning, all options on the table.
The president would tell you that all options are always on the table, and he's always ready to respond if he feels the United States is being unfairly treated by our allies and also our competitors around the world. But yes, the April 2nd day is a big day for the country, as the president has said. Reciprocal tariffs will go into effect.
So here's the latest this morning. US Trade Representative Jamieson Greer pushing for order after months of confusion over tariffs. Sources telling us here at Bloomberg that Greer is looking to take control of President Trump's upcoming tariff announcement on April 2nd. Tyler Kendall joins us now for more. Tyler, good morning. What's the latest on this front? What's behind this big push?
Yeah, John, good morning. Well, it appears the USTR has already started to implement some changes, including reestablishing a formal process for businesses and stakeholders alike to provide feedback. That's something that's considered to be traditionally done, but we've yet to see in this tariff rollout so far. Sources familiar do tell Bloomberg News that those requests will be taken into account ahead of April 2nd. And that could be critical, as that same report indicates that President Trump could ramp up or tone down tariffs depending on how he feels countries have been either cooperative or combative ahead of next month. And it comes as senior administration officials keep pointing us to the fact that we have seen some of our more unbalanced trading partners bring down those tariff barriers. But we've yet to hear if there's going to be any exemptions or carve-outs. We did get fresh reaction this morning from at least one trading partner, Australia's treasurer, saying that these U.S. tariffs so far have been, quote, self-defeating after the country failed to secure any exemption last week for those 25% steel and aluminum tariffs. John, just quickly, later on in that press briefing, the White House press secretary said that investors should be confident because they are taking the same first-term formula, as she called it. But she failed to mention the uncertainty that we have been seeing, as well as that it appears out of order, that we have yet to get that firmer fiscal agenda footing that we saw last time around.
Tyler Kendall down in Washington. Tyler, appreciate it. With us around the table to extend the conversation, Ed Mills of Raymond James. Ed, good morning.
Morning.
Good to see you. Let's talk about the April 2nd date. Conversation we've had around this table a few times now is how misleading that date might be. What actually happens on April 2nd? How long before these tariffs would actually hit?
In some ways, nobody knows. But what I'm expecting at Raymond James is that we will get some announcements that are immediate, but we'll also get some announcements that set in place a series of new kind of investigations. And what you hear with Jamieson Greer trying to take control of this is there's a real concern within the Trump administration on some staff that if you were to try to do all of this on April 2nd and use emergency powers, there's huge legal risk and it's going to get struck down. And so what can you do on April 2nd that goes into effect immediately, that can be upheld in the courts? And what can you do that sets in motion maybe a worldwide Section 301 investigation that can be defended in the courts, but ultimately still have a very high tariff rate that goes on basically every single piece of equipment and goods that come into the United States? That's still a very high probability, John.
So Howard Lutnick, the Commerce Secretary, actually outlined that to us as well. You could see some on April 2nd, and then some might be weeks or months down the line. So if they go on April 2nd, they're likely using IEEPA. What could we see them use IEEPA for and say, actually, this will hold up in court because there's national security concerns?
Yeah, so Annmarie, I would say there are some IEEPA stuff, and I think that the Mexico-China on IEEPA probably holds up. If there are other national security items, they could say semiconductors, clear things within our supply chains. But I would look back to the first Trump administration. They had a Section 232 investigation on autos. They could kick that in pretty immediately. They've already done some investigations on semiconductors generally under the Biden administration. Use that. There was a investigation into France on digital service taxes. They almost put in place a set of tariffs on France back in 2020 when Trump was in office. They could reactivate that. And there was also an investigation into currency manipulation in Vietnam, which could go into effect immediately. So take things off the shelf you've already done that are legally defensible and put that into effect on April 2nd. Seems like a pretty reasonable expectation.
Ambassador Jamieson Greer is very methodical. He flies under the radar. He's a lawyer. Mark Short had this to say: if you had people in the first Trump White House who fundamentally disagree with trade policy, this time around, they don't disagree with him on trade. They disagree with the implementation. Do you view it like that? Who's potentially holding Trump back from potentially his most aggressive policy proposals on tariffs?
So I think they have a team of rivals again. I think it is team economy versus team tariff. Team economy is Scott Bessent. I think the kind of overall kind of team tariff is Jamieson Greer, is Howard Lutnick, is kind of Peter Navarro pushing for it as much as possible. And on team tariff right now is Donald Trump. And so he alone gets to decide exactly what happens.
There were two dueling articles that I thought were really interesting. New York Times had an article yesterday about how Donald Trump is serious this time around, plans to put these tariffs on, and had a call with some of the auto manufacturers saying, guess what, guys, this is for real. You need to get used to it, 25% tariffs. There was an article by Bloomberg talking about all the people around him saying, hold on a second, we need to understand what the corporate concerns are and actually try to mitigate this with pro-growth policies, et cetera. Do you have a sense of how much this White House, and I mean everybody in the White House, actually does care about markets and what companies are saying?
Yeah, I think they care about markets. They care about the economy. I think what I hear from them is that this is a process, that they have to do the deregulation, get the tax cuts, do the tariffs, break down non-tariff barriers around the globe. And then you get the positive market reaction. What I'm hearing this time in Trump 2.0 is, wait for it. We have to put this all in place. If I get some pushback, is the process right now is too chaotic.
Well, that's what I was going to ask. Is there a process, or is it a concept? Is it concepts of a plan, or is it actually a plan?
I think it's more concepts of a plan, and I think that there is a lot of disagreement. Folks on Team Econ are not okay in the way in which this is being put out, but Team Tariff felt that they went too slow in Trump 1.0. If you go back to Trump 1.0, it was March 2020 before they signed the phase 1 trade deal. We've already, in the first couple of months, done more on tariffs than Trump did in 4 years the first time around. They say their biggest mistake in 1.0 was taking too long. So they almost don't care.
Just want to fit in this final question. Some breaking news about 5 minutes ago. We know this call is going to take place later on this morning at 9 Eastern time. President Putin demanding a suspension of all weapon deliveries to Ukraine during a ceasefire. That could come up on the call. We expect it to later on this morning between the two leaders. What do you think the outcome of all of that's going to be?
I don't think that's a realistic goal of this. However, I do know that Donald Trump likes to have any phone call come with a bold announcement. So I would expect him to talk up the opportunity of a ceasefire. But Putin is doing a good job of trying to reset the goalposts, because Donald Trump always resets the goalposts. And a lot of world leaders know if you can get him one-on-one, he usually agrees to more than what staff would agree to.
Well, that's the question we've got this morning, isn't it? We're going into the phone call. Will we get a one-on-one meeting in person off the back of this?
My reporting weeks ago was that Trump and the Trump administration wanted a meeting with Putin in Saudi Arabia by the end of February. Well, guess what? We're in March. It's Ramadan. Then there's Eid. Potentially, I would say you could see one, if this phone call goes well, in the next month.
Ed, it's good to see you, as always. Appreciate it. Thank you. Ed Mills there of Raymond James. Equity futures right now on the S&P 500, negative by, let's call it 1/3%. Up next on the programme, Elyas Galou of Bank of America on the latest fund manager survey, seeing record amounts leaving the United States and heading to guess where? To Europe. That conversation up next. Equity futures on the S&P down here by 1/3% on the S&P 500. A two-day run on the S&P amounting to a gain of about 2.8%. The best two-day pop going back to November of last year, shortly after the US election result. In the equity market beyond the S&P, the Nasdaq 100 down by 1/3%. Tesla still falling in yesterday's session. That stock down by some 18%. So far this month. Brutal stuff. In the bond market, 2-year, 10-year, 30-year, what do you do with retail sales yesterday? Just how weak are things? Beneath the surface, some cause for concern.
Yeah, if you look at some of the lack of buying of particularly autos, negative. When you take a look at the headline number, negative. The comp sales was the one bright spot. That comparable sales actually beat expectations, but downward revisions in the prior month. What you do with this is, it's not bad enough for the Fed to cut rates, but it's not good enough to lose some of the concern around a slowing U.S. economy.
So you mentioned the Federal Reserve. They go into this two-day meeting. If you're on the committee this morning and you start that two-day get-together, are you more focused on downside risk to growth, upside risk to inflation, or both? And it's the or both that's problematic to set policy for this Federal Reserve. In the FX market, things are straightforward for the year so far. You buy Europe, you buy the euro. Euro-dollar approaching 110, 109.34, positive 0.1%. An important vote taking place in Germany throughout this morning.
Yeah, you get a vote in the lower house of German parliament to try to see if they can get some of the spending actually enacted in short order. The expectation is they could end up with almost €1 trillion of spending on both infrastructure and defense at the same time that you have another positive impulse coming from the potential end of the Ukraine-Russia war. Try to put it all together. I know that we've all been trying to struggle with it. Markets are rallying in Europe, and that is the direct response.
The euro near the highs of the year. On our radar this morning, US Trade Representative Jamieson Greer pushing for order after months of confusion over tariffs. Sources telling us here at Bloomberg that Greer is looking to take control of President Trump's upcoming tariff announcement on April 2nd.
So this makes sense, right? This is the individual who is the trade lawyer who spent so much time working and learning under Ambassador Robert Lighthizer, who was Donald Trump's USTR head in Trump 1.0. We've seen a frenetic nature on how these tariffs are being rolled out. Sometimes it feels like his team isn't even aware of some of the truths that are about to hit our computer screens when it comes to tariffs. So Jamieson Greer, according to Jenny Leonard and the team down in Washington, is really trying to become more methodical about this approach. I think a key question is, what actually happens on April 2nd? What do they use using IEEPA and could be national security concerns? And then what are the other duties that we just have to wait weeks, potentially months? And in that time frame, how much market disruption could there be? Because Donald Trump will be negotiating.
You know, it's interesting. Some of the reporting really raises a more fundamental question, which is the anxiety in markets because of the uncertainty, or is it because of the tariffs themselves? And right now, people have been conflating the two. It's sort of the Trump put has been thought of as removing some of the tariffs. But is a Trump put equal to just creating a more reliable framework that companies could use to plan business? Is that enough of a Trump put to really galvanize some enthusiasm for the U.S.?
Can I say both? I know it doesn't help, but I'll say both. I think the administration's been much more aggressive on some of our biggest trading partners, Mexico, Canada, than some people predicted. Don't think the volatility helps at all. And at this point, the bar is so low that if you just told them it's going to be 10, 15%, give us something to work with, I think people would move on. It's difficult to move on when you don't know what the policy is going to be.
Which is the reason why reporting from Bloomberg is talking about trying to create a more predictable methodology. Larger question, who is actually driving the bus? It is President Trump. And whether he is sort of amenable to that type of structure is still a question mark.
And he's going to set the bar very high. This is an individual that enters negotiations and talks from a very maximalist approach to try to get to where he wants to be in the end.
You know, I followed the Greer story yesterday, and my view, my reaction to that is that's not so much about the policy, it's about the rollout of the policy. Because if you get the rollout wrong, to your point, in early April, you come out, you try and do too much, you get struck down, then you've got even bigger problems. For me, it's less about the policy, whether you agree with it or not. It's about the rollout of the policy. And the rollout over the last few weeks has been all over the place.
All over the place, frenetic, random. Whatever happened to the 200% on European champagne, wine, and cheese that I know, Jonathan, you're stockpiling? Whatever happened to that? Are we going to see that or not? So there has been almost spaghetti thrown at the wall when it comes to these tariff pronouncements, but there hasn't been a follow-up or even the process of how he would go about this. So I think that's why April 2nd is going to be very important, and probably why Jamieson Greer is dying to get his hands on it.
Stockpiling cheese can be problematic. We'll put it that way, all right? President Donald Trump expected to speak with Russian President Vladimir Putin later this morning. Putin is said to want all arms to Ukraine halted in a Trump truce. That call about 2 hours, 30 minutes away.
I'm not surprised by this headline and the reporting from Bloomberg, because what a source has said to me, Putin is going to go into this meeting saying he wants the land he currently occupies. Russia currently occupies 20% of Ukraine. Putin also has to prove domestically he's obtained the region most important to Russia, given the lives Putin has lost. He wants no NATO membership of Ukraine, which Donald Trump has basically said that's not happening anyway, and he wants sanctions lifted. This is an incredibly high bar, not just for this White House, but even more so for Kyiv and European allies.
We'll have more coverage of this in just a moment. Kit Juice, SocGen, will join us in about 15 minutes' time. Euro-dollar target for him, 113. We're just south of 110 at the moment. Wanted to squeeze this story in. What a development. BYD shares jumping to a record after the Chinese automaker unveiled a lineup of EVs capable of ultra-fast charging. The company's saying the vehicles can charge in 5 minutes. That's almost as fast as it takes to fuel a regular car. That could be a massive game changer.
And turbocharged BYD is the leading manufacturer of electric cars in the world. This goes to something Peter Tchir has talked about. China used to compete on value. It used to compete on just lowering the price. Now it's competing technologically. It's trying to say this is actually the better product that can charge faster, get more range, and be cheaper. That is going to be a difficult mix to counter with just tariffs or even just putting the walls up, especially for a place like Europe.
It's not just a cheap imitation anymore. We've seen some real developments come out of that country in the last 2 months or so. Tesla, by the way, down again this morning in the pre-market. It's negative by 1.6%. Let's turn to the Bank of America Fund Manager Survey. It came out a little bit early this morning, pointing to the erosion of US exceptionalism, US equity allocation falling the most in the survey's history, with the investor push into Eurozone stocks hitting the highest level since July of 2021. Joining us now to discuss, Elyas Galou of Bank of America. Elyas, welcome back to the programme, sir. I think it's good to sort of set the stage here and compare this release to the previous survey. What's changed in between the two?
Morning, John. It's great to be back. Look, I think what's really important is this survey is to understand that it was a survey for the record with some epic rotation in asset classes. Look, just to take a step back, the Global Fund Manager Survey has been around for pretty much 25 years, and it is so valuable because it offers clients with data on sentiment and positioning from institutional investors. And in March 2025, we saw the second largest rise in global macro pessimism in the past 31 years. For some institutional investors, March 2025 has felt pretty much like August 2007, August 2011, or even March 2020. The big difference, to answer your question, your institutional investors was a raging bull coming into 2025 with record exposure to the US. The bull has crashed, and your institutional investors is now ending the first quarter as a bear.
One feature of the last month survey that you put out was this massive drop in a cash level. And the equity market, I think, topped 24 hours later, all-time highs on the S&P 500. Elyas, what's happened to the cash level this time around?
Look, the cash level is one of the three big metrics that we look at when we analyze the fund manager survey. And as you said, it dropped below 4%, which is the key technical level that we look at when we say probably the market is poised for a top or a sell-off or a correction. And it remained pretty much below 4% since December. Now, the cash level has risen back above 4%, but also what's important is the speed of the increase in cash level from 3.5% last month, which, by the way, was a 15-year low, to 4.1% this month. And this kind of rise in magnitude of the cash level is typically associated with the end of a stock market correction. So that's a very bullish, important development.
Yeah, you pointed out the last time that we saw this speed of an increase in cash allocation was December of 2021. Does that make you think that maybe some of the rotation that we've seen, the flows of capital, have gotten kind of extreme in their magnitude of shifting into Europe away from the United States and toward cash?
Look, I think it's a very important point that you just mentioned, flows, all right? I mean, when you look at the fund manager survey, you see data on sentiment and positioning, what investors would like to do. However, you always need to compare the fund manager survey data with the flows data. On one side, we see a fund manager survey with epic rotation out of the US, in fact, the fastest rotation out of the US on record. At the same time, a big rotation into Europe. So in this sense, investors are buying Europe and selling the US. Now, what does the flow say? When you look at US flows, for every $100 of inflow into US equity funds since the US election, there's been less than $1 of outflow in the past few weeks. In fact, the outflow was recorded last week when it comes to US equities. Now, when it comes to Europe, what we saw in Europe is the big inflows in the past 5 weeks, the largest pretty much in the past 10 years. And that's why investors are saying they are not really selling the US, but they are definitely buying Europe.
Which raises the question of how much of a contrarian call this is. And Elyas, one thing that you've been really smart on is talking about how sentiment surveys can be contrary to indicators and sell signals or buy signals counter to what people are doing. You indicated that we saw the 7th largest rise in global macro pessimism in the past at least 31 years. Does that indicate to you this is overplayed? Or does that indicate to you that flows are going to follow, right? I mean, they're two counterpoints at a time of incredible uncertainty, but this hinting suspicion that maybe people have gotten overly pessimistic about the policy mix in the U.S. and perhaps a little optimistic about what's transpiring in Europe.
Sure, absolutely. Look, I mean, the old adage says flows follow returns. And so far, what we see is that flows have not really followed the price action in the U.S. because there's been almost zero outflow from U.S. equity funds. However, what we see at the same time is extreme speed of bearishness when it comes to the U.S. This is very US-driven. If you look at the fund manager survey, the big silver lining is the international developments. Investors are the most bullish they've been on Europe pretty much in the past years. Allocation when it comes to European equities is the highest since 2021. And even the UK now records a positive overweight when it comes to equity allocation. But you're right. If you are a contrarian investor today, and this is the value added of the fund manager survey, it's the contrarian trade that it offers, you would pivot back in favor of US equities, and in particular, you would buy the tech sector and the Magnificent Seven in the case there is a rally. And for a big rally to happen, you also need an easing of the trade war fear and the inflation fear.
Well, favoring or echoing the ECB's Digendos yesterday, this line stood out for me. The last time participants were this worried about one single development, it was 5 years ago when their main concern was COVID. Are investors concerned about the uncertainty of tariff policy out of the United States, or are they concerned about the actual tariffs?
I think both, right? I mean, John just mentioned before our conversation, it's the rollout, how the rollout of the policy is important. And if you look today at the US administration's rollout in terms of the big policy pillars, you see on the one hand tariffs, which is fueling business uncertainty, and the consequence of this is a pullback in investment. Just look at the NFIB survey last week that shows that business uncertainty for small cap is the highest almost it's ever been. And on the one hand, it's the impact on the labor market from the Department of Government Efficiency. And these two policy developments, they mean that US exceptionalism, which has been significantly driven by how exceptional government spending has been in the past 5 years, has probably peaked.
Elyas, appreciate your view. Fantastic survey once again. Great read. Very, very provocative on a morning like this morning. Elyas Galou there of Bank of America. Sentiment has soured so much. And then you look at the moves. If you just knew where sentiment was and where it has been, you'd think equities were down 20%. High yield spreads have blown out by some 200 basis points, and that's not what's happened. Not that kind of damage at all.
Not at all. I mean, we're down, a little bit more than 7% from the all-time highs. That's the kind of correction that we're in for the S&P 500. But what Elyas Galou said was really important. If you were going to be contrarian, you'd go into U.S. tech, because that has been a much more significant downturn, and that has been the barometer of U.S. flows and U.S. exceptionalism for the past 3 years.
Fantastic report from the team over at Bank of America once again this morning. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Trump says that Chinese President Xi Jinping will visit Washington in the not-too-distant future. Discussions between the two countries on trade and other issues are said to be stuck at lower levels. Both sides are deadlocked on how to proceed. Trump has said that he is open to reaching a new trade deal with China, even as he intensifies pressure. Elsewhere, Alphabet is said to have restarted talks to buy cloud security company Wiz for $33 billion. The deal could be announced as early as today, and it would be Alphabet's biggest acquisition to date. Wiz would boost Google Cloud's cybersecurity offering, helping it compete against Amazon and Microsoft. The Hong Kong billionaire, sometimes referred to as Asia's Warren Buffett, has died at the age of 97. Li Shaoqi founded Henderson Lane Development in 1973 and built it into one of the city's largest developers. His $23 billion fortune ranked third in Hong Kong. A statement says Li passed away peacefully on Monday, surrounded by family. And that's your brief. John.
Danny, thank you. Thanks for that. More from Danny in about 30 minutes' time. Up next on the programme, a defence spending boom.
But we are also now facing new two-sided shocks, mainly linked to trade and defense, trade fragmentation, and higher defense spending in a capacity-constrained sector could, in principle, push inflation up.
In just a moment, we'll catch up with Ollie Crook out of Germany on the vote that's set to take place in Germany this morning. From New York City this morning, good morning. Equities a little bit softer here. We're down 0.25% on the S&P 500. The bond market pretty stable going into day one of a two-day meeting for the Federal Reserve. Yields just about unchanged. Your 10-year 4.30.42. Under surveillance this morning, a defence spending boom.
But we are also now facing new two-sided shocks, mainly linked to trade and defense, trade fragmentation, and higher defense spending in a capacity-constrained sector could, in principle, push inflation up. But looking ahead, shocks might feed into inflation more directly and increase volatility.
So here's the latest this morning. European markets optimistic on the Eurozone's growth ahead of German lawmakers voting on a landmark defence and infrastructure spending bill later on today. According to Bloomberg Economics, the spending increase could boost German near-term GDP by 1 full percentage point. Bloomberg's Ollie Crook joins us now for more. Ollie, welcome to the programme. Just share with us, help us get familiar with the process that starts this morning.
Yeah, so Jonathan, right now the session has begun. So you have German lawmakers right now sort of debating this piece of legislation that is going through the parliament. We expect that vote in about 3 or 4 hours' time. And what we're anticipating is that they will, in fact, pass this sort of piece of legislation, which we should just take a moment to acknowledge how seismic this actually is, how much of a paradigm shift this is for Germany. We are talking about basically blowing to pieces two orthodoxies of Germany from the last few decades. One, a massive effort to remilitarize the entire economy, the entire nation, something that is obviously very fraught in the context of German political history, but also, on the other hand, doing it basically purely by debt financing. We're talking about a 500 billion euro infrastructure fund that is something that is not going to be subject to the debt brake anymore, that is going to be purely debt fueled. And then the other thing, defense spending. There is no limit, there is no cap on how much Germany can now borrow in order to basically boost its defense spending. There's also been another part of this, John, that they've also really massively expanded what is considered security and defense spending. So all of this culminates today. We're expecting this vote to pass. It will go to the upper house on Friday and should be signed into law by the president of Germany on Friday afternoon.
Ollie, any resistance to it whatsoever in Germany?
Yeah, so Jonathan, it's a very interesting question. There is actually some resistance to it. There have been a number of court cases filed by more of the sort of less mainstream parties, the FDP, the sort of libertarian party, the AfD, the far right, the far left. They've all sort of put stuff before the courts. Much of that has been batted away. But John, we should just take a moment to just observe and appreciate the politics of what's going on here. You have somebody who is not even Chancellor of Germany using a basically legally strong but basically politically no longer valid mandate in order to push through a constitutional reform in Germany on something that he spent 4 months campaigning saying that he wouldn't do in order to open up the fiscal space for himself, which he denied the last government. This is something that is, of course, very sort of controversial politically. Whether or not that will sort of stick with the Germans, I think will come down to a large part about whether basically almost €1 trillion of spending is going to be enough to basically make people forget about the politics of this because it turns the economy around. But this could cause even bigger problems and blow sort of even more fragmentation into what is a very sort of fragmented fragmented political landscape here in Germany.
Yeah, I was just going to say, it's not controversial when you take a look at markets, and they're rallying on this pretty dramatically. You're seeing the euro gain versus the dollar. You've seen German stocks reach record highs. How much is this potentially going to create a lot of fissures that are going to be politically difficult and delay some of the deployment of these funds that people are creating so much optimism around?
Yeah, so listen, I think the big question, and you point this out, is the pragmatics of this. How do you deploy this money? Where is this money going to be spent? How much capacity is there in this economy to absorb that, right? There is not the sort of capacity to do the military hardware at this point. That needs to be built out. How inflationary could this be? I mean, we have different estimates from different economists. We heard from the DIW, one of the sort of big research institutions here in Germany. They're saying that this could basically add 2 percentage points to the German growth figure annually for the next 10 years. And that's just the infrastructure fund. That is to say nothing of the defense fund. I mean, I was just speaking with the head of KKR's investment research, who happens to be in Berlin, and their head of infrastructure. They're saying that basically they see this as a massive opportunity. They're seeing and feeling the kind of euphoria in Europe that they haven't felt in many, many years. And they see it sort of coming out across the energy sector, digital infrastructure, all of these sorts of things. So I think for one of the first times in a long time, a lot of these sort of deal makers are really looking to Europe for something, for a place that they can actually grow after what has been a very sort of, we should say, sort of limping growth picture for the Europeans.
Oliver, I spoke to Mark Rutte last week, the NATO Secretary General, and he really was welcoming what was going on in Germany, especially as the Trump administration is pushing for NATO members to spend more. Their goal is 5% of GDP. Are you seeing that Trump effect as the reason why we see Germany rearming?
Undeniably. I mean, I think that whether people have been talking about it for a very long time, I think the reality of what a Trump presidency means and the reality of what his policy proposals are have really brought basically this issue to the fore across Europe. And it's not just Germany. The difference is that Germany has the fiscal space to move in a massive way on this, a very big way. You can't just go to Italy, you can't just go to France and say, hey, listen, we're just going to tack another percentage of GDP spend of our GDP to defense spending. That's just not an option that most of these countries have. The Germans do. And when you look at the impact that it's had on the market, it's much bigger than any of the EU-wide initiatives that they've been talking about. I mean, I think the only thing that could arguably be bigger is the question of joint debt at the EU level, and we're still some distance away from that. This has been an absolutely huge boon. I mean, this is going to potentially also raise European growth across the board over the next couple of years by potentially 0.5 percentage point. So this is going to benefit, yes, Germany, but potentially Europe more broadly.
It's a massive regime shift. Ollie, just before you go, plenty of discussion on the programme this morning about a conversation between the Russian and US presidents later on this morning. Ollie, how's Europe responding to that? A phone call between Putin and Trump?
I mean, listen, we get comments from European officials, but at the end of the day, Jonathan, unfortunately for them, they're not really even a part of this conversation. So they're just sort of watching and hanging back and seeing basically how this develops. What we need to watch very closely to get out of this conversation with Donald Trump and Vladimir Putin, because the one thing we really don't know about Trump's position is how many of these sort of red line demands, which are very aggressive by Putin, the U.S. administration is basically willing to entertain. That is something that is a huge question mark for the Europeans, and I think everybody is watching very, very closely.
Ollie, appreciate the update. Great work as always. Ollie Crook out of Berlin this morning. Later on this morning, President Trump, President Putin holding a phone call.
And there's a lot of trepidation right now in Europe, to Oliver's point, but Europe's not at the table. And that's kind of the problem. They're knocking on the door and Trump's not really allowing them in. He wants this to be bilateral between the United States and Ukraine, the United States and Russia, to bring these two individuals together. But Putin, according to our reporting, is coming in with some heavy demands.
9 o'clock Eastern time?
Potentially that's as early as it could start. Anywhere between 9 and 11 Eastern, it could start.
That's a few hours away. Equity futures on the S&P down about 0.25%. Up next on the programme, Tom Becker of BlackRock, Andrew Bishop of Signum Global, Aneesha Sherman of Bernstein, and Greg Tuorto of Goldman Sachs from New York City. The second hour of Bloomberg Surveillance. Up next.
The underlying story is still weaker. You clearly see weakness in soft measures of economic activity.
We'll need to start to see more hard data roll over before we get a little bit more concerned.
At worst, the Fed stays on hold for a while, but if something does materialize that's much worse and the Fed does have to ease, they'll provide protection in a portfolio.
The Fed is right now no probability that they will cut in the next month or two.
You need time to process what is effectively a meaningful dose of uncertainty that's been injected in the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 negative by 0.2%, just a little small softer pullback on the S&P following 2 big days of gains, up over the last 2 days by close to 3%. On the Nasdaq 100 down by 1/3% over the next 24 hours. One big event gripping global markets, a 2-day FOMC meeting begins later on this morning, concludes tomorrow.
There's a question of how much the Fed is willing to be the relief valve for a market that is looking for one, that wants to see a put come in somewhere, whether it's from the Fed or the Trump administration. Will they emphasize the slowing growth profile of the United States over inflationary concerns? And if they don't, what does that do with the ongoing trend of bonds not acting as a buffer to the equity sell-off?
We talked about this in a previous hour. Are they gripped by downside risk to growth or upside risk to inflation, or both? And it's the both that puts this Federal Reserve in a sticky position. Why? Because they're focused on policy coming from the other side of Washington, and that policy can change from day to day, minute to minute.
Especially when it comes to inflation. Even though it's a one-time price hike, as the administration will talk about it, it still could be inflationary when it comes to things like tariffs. And how do you decide on Fed policy when you're unsure of what the tariff level or the tariffs on which trading partners are going to be? So for the Fed, they might have actually an easy excuse today saying, we can't comment because we need April 2nd to happen first.
The data has soured. The sentiment data, the survey data has soured. We got retail sales in the last 24 hours. Beneath the surface, away from headline, we talked about this briefly before, there was some cause for concern out there.
Especially because last month, the prior month, was downgraded in terms of the revisions downward. You get the sense that maybe there has been some froth taken out of consumer spending. Some people will say it is just payback for really robust spending at the end of last year. Some people say that even the auto figure looks like maybe it's a little too pessimistic and people bought a little bit more. These are all subject to revisions. That said, it's just bad enough to continue with the concerns about a weakening consumer, and they're not bad enough for the Federal Reserve to come in and rescue the market.
Which is why people have soured on U.S. equities, captured by the Bank of America Fund Manager Survey, capturing everything we already know. Incredible bullish sentiment on the European continent, and we haven't seen that for a long, long time.
And it is fueled by the sort of 1-2 punch that we get today. I mean, really, if you talk about event risk and a historic event risk, it is today, and it is in Europe, with the idea of a call between President Trump and Vladimir Putin, with potentially coming to some resolution of the Ukraine-Russia war at the same time that there's a vote about what fiscal spending, which is sort of anathema to the culture of Germany. But guess what? It is happening in Germany.
And one has informed the other in a big way.
Absolutely. When it comes to Lisa's point, this is an inflection point. We could look back at this phone call being massive in terms of history, because this could be the day that Putin decides he will sign up for the 30-day ceasefire. The issue is he's coming into this call with an incredibly high price. We have reporting that prerequisite for him to sign up on this 30-day ceasefire means no more military equipment coming into Ukraine, especially from the United States. That is going to be something incredibly difficult for Zelensky to swallow, as well as European leaders.
The euro close to 110, 109.36 this morning, positive by 0.1%. New lows for the dollar, new highs for the euro in the last 24 hours, for the year at least, for 2025. This morning, equity futures pulling back by just 0.2% on the S&P. Coming up this hour, Tom Becker of BlackRock as stocks look to build on a 2-day winning streak. Andrew Bishop of Signum, with President Trump set to speak to President Putin. And Aneesha Sherman of Bernstein, with retailers bracing for a consumer slowdown. We begin this hour with stocks steady as the Fed's 2-day meeting begins. Tom Becker of BlackRock writing, inflation data continues to appear inconsistent with achieving 2% on any policy-relevant horizon. We'll be watching tomorrow for how FOMC members incorporate the stagflationary US data revisions into the 2025 rate path. Tom, good morning. It's good to see you. I was thinking of you earlier this morning, went short buns in February, and I just thought you should take the rest of the year off. You made that shift to Europe early for the equity side of things and got away from buns at just the right time. You must be feeling good.
In the nick of time, yeah. I mean, part of it was the European growth data started to inflect in January and February. So some of the U.S. Leading indicators were getting a bit toppy November, December. Europe started to shift a little bit more positively, but then some of our fiscal insights started to turn. And as you know, and as you were just talking about, fiscal's been the driver of markets post-pandemic. And so this fiscal shift in Europe with Merz sort of being the anti-Merkel, Merz kind of taking the Bidenomics playbook of guns, butter, infrastructure, kind of defense spending, and applying that to Europe. The pricing just wasn't set up for that, and positioning really wasn't there. And so you've just seen this huge rotation of positioning kind of undoing Q4s.
And huge unexpected divergence between the performance of European and US equities, where US equities have really lagged. Where are we now? And just going into the Federal Reserve tomorrow, what kind of policy response would you like to see over the next several meetings that might change your mind?
I think they've been pretty clear that they're on hold here. So December, they kind of iced the easing cycle. I think the data they've gotten since, even subject to the uncertainty, I think that they think that this is a good level to stay at, given that the labor market appears pretty firm. It's mostly been a sentiment data concern, and the inflation data and the inflation expectations are shifting up. I think it's sort of those expectations. You can dismiss one survey, you can dismiss another survey, but as they all gradually grind higher, I think they do worry about kind of a de-anchoring of their commitment to 2%. And so just staying put would be a shift relative to what's priced in markets now.
I'm laughing because I remember when the Federal Reserve pointed to the University of Michigan sentiment survey and inflation expectations as a reason to make a move one way or another for their policy action. Could we see a similar type of reference at a time where there is no survey like the UMich survey that triggers so many people with such violent emotions? I mean, truly, it's sort of shocking. But do you think that once again, this is in the driver's seat?
I think there's a New York Fed survey where it's started to grind higher. The Michigan survey has a lot of challenges with how they're polling and the partisan kind of nature of it. But overall, if you look at break evens on a 2-year horizon, if you look at kind of the surveys in aggregate, they're drifting higher. And so that's just in conflict with where they were at the end of last year, saying, we're making steady progress, kind of 2 steps forward, 1 step back. It looks like kind of the direction of travel has changed. And that makes sense with kind of, Annmarie, you were saying with the tariffs and just, the sense that prices have to drift a little higher here to accommodate some of these changes.
Which raises the issue of what we're pricing in right now. Are we pricing in the idea that these tariffs or policy uncertainty continues, or both, and that the United States is truly going to lose the exceptionalism, which could be a contrarian buying indicator, or are we pricing in something of just a little bit of turmoil that will pass and that will essentially be met with either a Fed put or a Trump put?
I think exceptional, you could frame it the other way, glass half full, glass half empty. Like the U.S. exceptionalism is Europe and China now kind of taking the U.S. playbook with fiscal and kind of maybe taking over the leadership mantle. So the U.S. has been the only place where we found economic growth, the only place where we found earnings growth over the last few years. It looks like there are signs now that economic growth is going to be a little bit stronger, a little bit firmer outside the U.S. Earnings growth, too, with kind of these fiscal measures that are going to feed into corporate profits outside the U.S. I think you can frame it that way, which is the global economy is pretty resilient. It's just the U.S. is no longer the only game in town.
So you're saying U.S. exceptionalism, European exceptionalism, Chinese exceptionalism all at the same time?
Yeah, well, I mean, that's kind of what fiscal is, right? So you had kind of a decade of austerity. You've had now kind of the government checkbooks opened up in sequence. And I think that is where bond yields have started to react. In Europe, but we're going to have another fiscal event in the U.S. There's one big, beautiful bill coming, and it looks to be very big. And the reconciliation and kind of what gets chosen to be added is not much talk about what you're going to subtract from it. And so I think kind of the amount of fiscal stimulus that's coming on both sides of the Atlantic is going to be pretty big.
John started off making a point that you nailed the first half of the year. The second half of the year, once we get over tariffs, is going to be all about potentially deregulation and tax cuts. What do you want to do in that scenario?
So I think it comes a little bit to the fiscal multiplier. So it's a very different dynamic to give tax cuts versus direct kind of stimulus and kind of when you have companies want to invest because you're co-investing with the stimulus, kind of what you had with Bidenomics, a little bit similar to what's happening in Germany, where you're saying we're going to be doing the military spending that's going to flow through to the companies in those industries. Tax cuts are just not as stimulatory. A lot of it gets saved. And so I think that's part of the dynamic in the U.S., where the concerns about what's the next thrust for the U.S., the consumer is set up pretty well. there are wobbles in the industrial sector, but is this going to be this continuation of the TCJA? It's not really a simulatory because it's current law, and so there's some sweeteners in there, and there's some additional tax easing, but it's not nearly as big as kind of these big marginal programs.
If everyone's exceptional and everyone is investing in fiscal spending, are bonds remarkably unexceptional around the world right now?
They're not a great long-term return. So when you look at where cash yields are, you look at kind of long-dated yields, and kind of from our perspective, the risks are for higher inflation and higher issuance. Populism tends to lead to higher inflation, higher issuance. We did some work on insurance in California. The dynamics are pretty bad, and that feeds through into the prices of kind of everything that you buy. So the price to insure your property goes up, the price to insure your warehouse goes up. That means that you get markups, you get restaurants marking up their prices, and it's not in the CPI itself, but the cost of kind of insuring kind of an asset base that's gone up 40, 50% since pre-pandemic, the kind of catch-up dynamics of that, we think are just going to keep services prices sticky, and then you add on the tariffs, and then you add on the defense spending, and then you add on tight labor markets. And it seems like markets are priced for they're still pricing for kind of the secular stagnation, new normal. And we're back in kind of, much more of a 1990s type of economy, which is just higher yields and higher wage growth and slightly higher inflation.
Hey, Tom, you've made some fantastic calls over the last few months. We're all listening to you now in a much more bigger way. Tom Becker there of BlackRock on the bond market and on equities as well. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Trump has picked Federal Reserve Governor Michelle Bowman to serve as the central bank's vice chair for supervision. Bowman is expected to support a lighter touch on bank regulation than her predecessor, Michael Barr. Bowman has been a sharp critic of plans to require banks to hold more capital. BYD has unveiled a lineup of electric vehicles that it says can charge almost as fast as it takes to refuel a regular car. The new battery and charging system can provide about 249 miles after 5 minutes of charging. BYD plans to sell the cars with the new technology next month. After 9 long months in space, 2 NASA astronauts are finally heading home. Butch Wilmore and Suni Williams departed the International Space Station aboard a SpaceX Dragon capsule at 1:05 a.m. ET, beginning a 17-hour trip to Earth. The astronauts are due to splash down along the Florida coast around 6 o'clock tonight. And that's your brief, John.
Hey, Danny, what a turnaround. What a turnaround for them. Just phenomenal. About time, right? Months.
Can you imagine? I mean, can they even still walk? I mean, say it, because don't your muscles have issues?
Oh, they need to do some serious physio.
Yeah,
that's for sure.
They're going to have a medical visit before they go to their families, and their families were like, well, we were expecting to see you at, 8
months ago.
Yeah, exactly.
Up next on the program, peace talks with President Putin.
We're going to see if we can work a peace agreement, a ceasefire and peace, and I think we'll be able to do it. I'm speaking to President Putin tomorrow morning.
That call set to take place later this morning. Andrew Bishop of Signum joins us next from New York City. Good morning. The Treasury Secretary Scott Bessent speaking just moments ago to American media. Some of the headlines for you. On April 2nd, each country will get a tariff number. For some countries, on April 2nd, that tariff might be quite low. 15% of the countries make up a lot of the trade with us, so a lot of those tariffs are going to go on 15% of those countries. All of this is still coming together ahead of that April 2nd date.
It feels like they're out loud talking about the negotiations and some of the work that they're doing to try to, what they would call, have reciprocity when it comes to America and its trading partners. What's interesting here is they won't be automatic, 25% plus 25%, the Treasury Secretary had said. And I think it's interesting that some countries it actually may be low. So maybe for some countries, actually, they don't need to fear so much about what Donald Trump has been talking about.
Nothing to fear on the economy as well. The Secretary going on to say that the underlying economy is healthy. There's no reason for there to be a recession. And asking for a guarantee that there won't be a recession is is silly, so start asking. Apparently, they think that's the message coming from the Treasury Secretary this morning. Equity futures right now on the S&P 500 is down about 0.2%. In the bond market, yields just about unchanged, 430.62 on a 10-year. Under surveillance this morning, peace talks with President Putin.
It's a bad situation in Russia, and it's a bad situation in Ukraine. What's happening in Ukraine is not good, but we're going to see if we can work a peace agreement, a ceasefire and peace, and I think we'll be able to do it. I'm speaking to President Putin tomorrow morning. We're trying to get a peace agreement done. We want to get a ceasefire and then a peace agreement.
So here's the latest this morning. President Trump speaking with Russian President Vladimir Putin this morning about a ceasefire in Ukraine. Tyler Kendall joins us now from the Washington, D.C., from the nation's capital for more. Tyler, welcome back to the programme. Let's just set the stage, just frame for us the stakes of this call, what the ask will be from either side.
Well, John, an incredibly high-stakes call after weeks of intense dialogue, reporting this morning that Putin wants to see all weapons flows to Ukraine halted amid Bloomberg News reporting that he could really slow-roll these negotiations over concerns about Western security assistance, Ukraine's neutrality, and seized territory. Now, for the most part, this White House, as you heard there from President Trump, has remained relatively optimistic, despite Vladimir Putin failing to publicly commit to that 30-day peace plan that the U.S. is backing. I spoke to one foreign policy expert who described this as a tightrope for the Kremlin, considering Moscow does want those strengthening in relations with Washington. We know, for example, that commercial ties are going to be discussed on that call today as Russia really seeks greater access to Western financial markets. Now, the other part of this, which we have been covering at this point for weeks, is the alarm that our European allies are sounding amid these direct talks with Russia, that it could pose concerns for Ukraine over accepting potentially a deal seen as unfavorable. Perhaps the biggest question there is the future of security guarantees and whether or not the U.S. will commit to back any. And John, to be sure, Ukraine has agreed to that 30-day ceasefire proposal backed by the U.S. And yesterday, President Zelensky said that he is urging the U.S. to hit Russia with sanctions if they do not also agree in short order. It is something that the White House press secretary did not rule out.
Tyler Kendall from Washington, D.C. Tyler, appreciate it. Let's build on this conversation with Andrew Bishop of Signum Global Advisors. Andrew, welcome to the programme. I asked Tyler to sort of frame the call, what the stakes are. Can you frame for us your expectations, what you and the team expect to be the outcome of this call?
I think the expectation is, first of all, that from the Russian perspective, this call is very much about U.S.-Russia relations, bilateral relations. It's not about Ukraine. So that's the first thing, is they're trying to set expectations and try to narrow the conversation to the U.S. relationship with Russia rather than to any sort of ceasefire agreement with Ukraine. Now, in terms of Ukraine itself, I think this is going to be Putin, bouncing the ball back to the Ukrainians by saying, I will indeed agree to a ceasefire if Ukraine fully pulls out of Kursk. It's already left for the most part, but fully. And if President Trump can give me assurances that there will never be European peacekeepers in Ukraine and that I will be able to get most of the four regions, including parts of those four regions that are currently unoccupied by Russia as of now.
Andrew, on top of that, we have reporting that Russia wants to make sure that the U.S. halts weapons flows before signing up to a 30-day ceasefire. Is that something this administration would agree to?
Yes, I think anything that Russia asks of the administration, it will likely get. And I don't mean that in an exaggerated sense. It's not because we view President Trump as somehow a Kremlin puppet or anything like that. It's just because President Trump wants this conflict solved and he wants it off the agenda. So I think President Trump would be inclined to agree to pretty much anything Russia asks for.
But he wants it solved enough that he would maybe accept a poor deal or lose leverage in the negotiations?
I do think he would. That was not my expectation a month ago, but I think we have to learn from his demonstrated and empirically proven behavior, and I think that is where he's headed. The problem he's going to face, though, is that only applies to what the U.S. can deliver. So what I mean by that is the U.S. can stop sending weapons to Ukraine, but it cannot, or it would be much harder to force the Europeans to stop sending weapons to Ukraine. The U.S. can recognize Crimea, but it can't force Ukraine to recognize that Crimea has been, taken over by Russia, and so on and so forth. And so that actually does put a big limit to what Trump can deliver to Putin.
In early February, the Treasury Secretary Scott Bessent sat with us around this table and talked about how there's a menu to increase pressure on Russia, dial up the sanctions, or draw them back, depending on a negotiation stand. Is that where Treasury is today?
Yes, it is. I mean, that is where Treasury is today in the sense that all options are on the table. But to be very clear, I think this administration might be willing to tighten sanctions on Russia, but it will not be willing to impose the type of sanctions on Russia that would be required to get Russia to cave, right? So it's a zero-sum game. In order to really get Russia to cave, you need to put major sanctions on the country, and that's not something this administration will be willing to do, I don't believe.
Andrew, what is the potential risk for the United States if the U.S. agrees to something with Vladimir Putin that really increases the fissure between the U.S. and Europe?
So as long as it stays at the level of the U.S. doing things that previously were considered, morally reprehensible or unbelievable, incredible, like recognizing Crimea as being Russian, as long as it's at that level, I think those expectations are baked in as of now. Where it would get really problematic is if the U.S. starts doing things like using ITAR and export control restrictions to prevent Europe from supporting Ukraine itself. Right? Because at that stage, that would fundamentally undermine the U.S.'s not just credibility of security guarantees and diplomacy, but specifically of military procurement or provisions by American companies to the Europeans. That would be a huge issue. And that's something I think Trump won't do.
There's something that John has raised, and I think it's a really good question, which is what is the signal that Vladimir Putin is taking from the fact that Germany is expanding its military budget and there's a rearming of Europe to try to defend against Russia at the same time that the U.S. is trying to negotiate a deal between Ukraine and Russia?
So I think that he welcomes, because it's actually giving him, because on the one hand, the rearmament, although real and, although it has some legs, is no threat to Russia anytime soon, right? So he's not sort of shaking in his boots. And at the same time, this rearmament by the Europeans is giving him an amazing talking point, which is the reason the Europeans are standing up for Ukraine is not because they want a fair peace, it's because they don't want peace. And that is an absolutely amazing talking point for the Kremlin.
Andrew, just finally, just a quick question. The amount of LNG, the amount of Russian energy that the Europeans are still buying, what are those levels at the moment? Because I find it to be the most contradictory point of this whole war and the effort of the European capitals over the last several years. Just how much European energy, how much Russian energy are the Europeans still buying?
It is indeed entirely schizophrenic and contradictory. And as you've said, not only are those levels high, but they've actually increased over time. So yes, it is Europe shooting itself in the foot. The one thing I will say is we think that even if there is to be a peace deal, which is not our expectation, it will not involve a return of piped Russian gas anytime soon. So from that perspective, I think the Europeans have turned a corner to some extent.
It's quite a corner to turn. There's one big one left to take, and they haven't taken it. Andrew, appreciate it. Andrew Bishop there of Signum Global Advisors. It's shocking to see the numbers, isn't it?
Rystad Energy came out in early this year, talking about the fact that Europe actually for 2024 bought a record amount of liquefied natural gas from Russia. At the same time, they're sending aid to Ukraine, and then also pointing the figure at the U.S. administration for wanting to get on the phone with President Putin and bring an end to this fighting. So the problem with the Europeans is they kind of talk out of both sides of their mouth.
And then spending all this money to increase your defence capabilities against the country that you're funding right now. It's bizarre.
Andrew's point on that was fascinating. He said it's a fantastic talking point for Vladimir Putin to say, look, they want to keep fighting. They want to bring down Russia. So, they're not necessarily going to have a seat at the table. Whether that is going to be what actually gets the negotiations going, we'll see.
The fact of the matter is the West, whether it's the United States or Europe, were never willing to take the steps because it would hurt their own economies. That would bring the end to this war, which is Putin having no funds to fight it.
Equities right now negative by 0.2%. That call set to take place later on this morning. Up next on the programme, Aneesha Sherman of Bernstein as retailers brace for a consumer slowdown. From New York, this is Bloomberg. This is a great post by Hugh Van Steenis this morning out on X. There was a 44% increase in attendance by US investors at Morgan Stanley's European Financials Conference today. The interest has shifted pretty quickly, hasn't it?
People are looking for opportunities. We heard that from KKR this morning about potentially investing in infrastructure. But European financials have been the unexpected bright spot. What have they always been? The death trade for everybody? Well, no longer. And the fact that U.S. investors are saying, all right, whatever, policy difference, whatever, let's go for it.
Massive turnaround in the first few months of 2025. Equity futures right now on the S&P 500, just a little bit softer. We're down by 1/3% on the S&P. On the Nasdaq, we're down by 0.4%. We're 2 hours away until the cash open. Let's get you some morning movers with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Lucid getting a boost here in the pre-market, up 2.3% after getting an upgrade by Adam Jonas over at Morgan Stanley, changing his rating from underweight to equal weight. And let's remember, this is a stock that has been in a rut since the sudden departure of its former CEO. But Adam thinks that with new leadership, he sees scope for Lucid to play a role in the AI theme, which he says could re-rate the stock. Next up, we have another EV maker, but that is moving in the opposite direction, down nearly 2.5%. Tesla shares on this news that BYD's new EVs have raised the bar, offering ultra-fast charging. Just another sign of the Chinese company's growing dominance as it closes the gap on Tesla. I will also note that on top of this, Tesla did just get a price target cut from Tom Narayan over at RBC. And last up, we have Ralph Lauren shares. Those are up 2.8% after Goldman Sachs upgraded the stock to a buy and raised their price target. They say this is a company that has been executing well. The analysts also noted that Ralph Lauren has more limited exposure to near-term risks, including tariffs, as well as the health of the lower-income consumer. John?
Yahara, thank you. More from Yahara in the next hour. We'll get you some more movers a little bit later. Here's one right now, JP Morgan. This according to our reporting. Really interesting numbers here. According to people familiar with the matter, JP Morgan is on track to boost revenue from equities trading by more than 30% this quarter from a year earlier.
And that would put it on track for a record haul when it comes to equity trading revenues. Raises a question. Okay, we've seen a lot of bad news getting priced into the banking stocks just simply because there isn't the apparent wave of M&A that a lot of people were expecting, deals, the dynamism, et cetera. Can it be offset by the fact that volatility can be a good thing? There's good volatility and bad volatility, as we've learned, and maybe this is good volatility when it comes to stock and bond trading revenues for the banks.
The golden age of volatility. We'll talk about the M&A in just a second. On our radar this morning, German lawmakers voting on a spending bill unlocking hundreds of billions of euros for debt-financed defence and infrastructure spending. The Chancellor-in-waiting, Friedrich Merz, already securing the two-thirds majority he needs.
This is all set to go through. They have a buffer of 31 votes, basically something that I imagine Speaker Johnson would be incredibly jealous about. What I find so interesting about this is something Oliver Crook brought up earlier, the politics around it. This is an individual who is not even chancellor yet. Arguably, this is a government that does not have a mandate, yet they are pushing this through. And what kind of precedent does this set for the future?
The politics of it interests you. The economics of it really interests me. I want to understand how they're going to deploy this and what the ramifications are, not just for the growth aspects, but also inflationary aspects when it's hard to see whether they have the workers, the supplies, where are they going to get those supplies, the raw materials to really build up their military as well as their infrastructure. A lot of questions here, aside from just the knee-jerk boom.
We've gone from discussing parity on euro dollar to 110, just like that, 109.33 right now, and positive by 1/10% on that currency pair. Elsewhere, here's some news for you. President Donald Trump's top trade negotiator, Jamieson Greer, looking to inject order into tariff policy after weeks of confusion. Sources telling us here at Bloomberg that Greer is prepping to take control of the administration's April 2nd reciprocal tariff rollout.
I think this is important because we've seen in consumer sentiment surveys that the tariffs has been driving consumers with some anxiety they have going out and spending and what potentially the price levels could be in the future. Jamieson Greer, great reporting by Jenny Leonard and the team, is an individual who really flies under the radar. He's not out on the TV screens like you see the Commerce Secretary Howard Lutnick, and he's trying to bring a more principled, methodological approach to the tariffs because right now it's been tariffs by truth. And it's been very confusing to see what actually the administration is going after. Is it fentanyl? Is it reciprocity? So April 2nd, Jamieson Greer getting his hands on it, I think potentially is market positive. But we still don't know what the tariffs are. It feels like they're building the plane as they're flying.
So April 2nd, you might get the announcement of some tariffs. You might also get the announcement of some investigations that could well lead to some tariffs further down the road. So if you're hoping for clarity after April 2nd, there could be a new runway of several months before you really get your hands around what the full trade picture looks like.
Which goes back to the question, what are people looking for with a Trump put? Are they looking for certainty, or are they looking for a walk back of some of these tariffs? Or is it some combination of both? And how are they going to get it when uncertainty is part of the whole program?
So for the business community, they came into 2025 looking to invest and hire. Now they've gone into wait and see. How long do they have to wait? How long before wait and see becomes fire and divest instead of hire and invest? Because at the moment, we're somewhere in between. Maybe it's several months, maybe it's a year. I don't know the answer to that question, but the patience of corporate America is being tested.
This is the reason why I thought Jenny Leonard and the team had a really interesting take, and that story was so important. Susie Wiles, the key advisor to President Trump, also said to be trying to get some of these concerns among corporate America in front of the president so he understands some of the uncertainty and what it's doing potentially down the line, not just to a freezing of plans, but exactly to what you're talking about.
Speaking of policy, we mentioned M&A. Check this out. Capital One saying it's, quote, well positioned to gain approval for a $35 billion deal to acquire Discover. Sources telling us here at Bloomberg the DOJ is concerned, saying a merger will harm competition.
So it sounds like something we heard continuously during the Biden administration. And this comes from this Capitol Forum. They posted on LinkedIn saying that the Justice Department staff had misgivings about the deal. So potentially this can hold back that approval. I'm reminded what Senator Dick Durbin had to say about Donald Trump's pick for antitrust division Gail Slater. We discussed top priorities to protect consumers, including bringing competition to the debit and credit card markets. Potentially, this is going to be harder than people expected.
David Costin, Goldman Sachs. Due to the softer macroeconomic and market backdrop, we reduced our forecast for completed 25 US M&A volume growth to 7%, down from 25, a function of growth, CEO confidence, financial conditions, weighing on all of the above.
And maybe you can add to it maybe a less friendly antitrust environment than a lot of people thought going into this administration.
It's not what we expected. We did have this conversation about whether the J.D. Vance wing of the party would get its hands around the antitrust effort, and here we are.
Yes, but when it came to big tech, because remember, that started actually in Trump 1.0, and something that at tech forums, J.D. Vance has said things like, I actually think Lina Khan is an individual that's doing good work in the Biden administration. But now it seems like actually it's broader than just the tech space.
That's the latest on the merger push. Let's get you the latest on the consumer. Disappointing February retail sales pointing to a pullback in consumer spending in the United States. Investors looking ahead to earnings from Five Below, Nike and others this week. Aneesha Sherman of Bernstein writing, a combination of bad weather and macro uncertainty around tariffs and immigration have put a lot of pressure on consumer sentiment. Aneesha joins us now for more. Aneesha, welcome to the programme. This word transitory was used by Ed Bastian, the Delta Airlines CEO, and I think we all want to know how transitory this weakness might actually be. What's your view on that?
I think it depends a little bit on where we land on tariffs per your earlier conversation. So, there is some weakness that hasn't even fully come through yet. We haven't seen the full effect of price raises that the tariff policy will result in. That is only just starting. So I think it could get better, or get worse before it gets better. The magnitude of how bad it could be depends on where we eventually land with tariffs. Do we end up putting tariffs on more countries beyond just China, more countries in Asia? Do we end up raising the tariffs on Canada and Mexico? Are there other retaliatory tariffs that we don't know about yet? All of those will result in price increases over the subsequent several months. And so this is kind of a lag effect. We're only starting to see the beginning of it. And if this is the extent of it, then maybe it will be transitory, but we're not entirely sure yet.
Aneesha, we know the low-income consumer has been squeezed for quite a while. One pillar of US consumption has been the high-end US consumer, particularly for retail. Something we saw in the airlines is that long-haul and premium has held up quite well. Are you seeing any sign of weakness for the high-income consumer for the companies that you cover?
We started the year with a very bullish high-income consumer. In January, every higher-end retailer and brand were talking about a super strong holiday season, very low inventory, very strong January. We saw it in our own survey results of thousands of consumers. Above $100,000 earners were much more bullish about spending this year. That sentiment has also dampened. It hasn't dampened as much as it has for lower income, but yes, it has certainly taken a downward shift since the beginning of the year.
Aneesha, how much is this uncertainty being driven by tariffs, and how much is being driven by pullbacks from government spending, from the fact that you do have people who are uncertain, not just about if they have a government job, but if they are a contractor? There just is a different feeling among businesses that seem to be on hold rather than the go-go days of peak fiscal stimulus.
I think it depends a little bit on where we land on tariffs per your earlier conversation. So, there is some weakness that hasn't even fully come through yet. We haven't seen the full effect of price raises that the tariff policy will result in. Yeah, I think that's absolutely a part of it. That part also is relatively new, right? So many of these jobs have only just been eliminated in the last few weeks, so we haven't seen the full impact on spending yet. And the second piece of this is corporates. I mean, corporates are pulling back on investment and hiring at the moment because they don't know what to do. They don't know if this is a time to shore up cash and have a strong balance sheet in the wake of a possible recession, or to go ahead with that capex and go ahead with that hiring wave. So they're kind of in limbo mode at the moment, which also puts some pressure on jobs.
How big is the gap between remaining on hold, this is to John's question earlier, and actually engaging in cuts, starting to trim around the edges, reduce overhead costs with the elimination of jobs in a way that could be the next phase of uncertainty that leads to real action?
We're not there yet. We're not at the point where companies are saying we need to tighten the belt, we need to do some layoffs. We could be there. I think if we see strong signs that we're heading towards a recession and companies feel like they do need to tighten the belt, we could lead to that second step. We're not there yet. Right now, we're just in the wait and see mode, the inaction, the kind of, waiting to see where the chips fall. It could be a possibility, I think, if things get worse on the spending side.
Who's the big winner in this kind of environment?
Gosh, I don't know if there is one, but I think if I had to pick within the space of discretionary retail, I would pick brands that are more exposed to a higher income consumer, which is more resilient, less exposed to some of these spending shifts and pullbacks, and companies that tend to win in times of downturns. So my picks would be someone like a TJX, which does tend to win in terms of downturns. It's almost zero beta or sometimes negative beta. If you look at the GFC, it was a big winner. And I would pick higher income exposed names like someone like a Tapestry or an On, where the price point is high enough that if there are global tariffs, they can maybe pass on some of that. They can absorb some of that without really wrecking the business.
Aneesha, appreciate your view on things. As always, thanks for catching up with us. Aneesha Sherman there of Bernstein on retail. I see On sneakers everywhere now. Yeah. Everywhere, more than I see Nikes.
Well, they did a really good job at going to all of those running groups that you see in the morning when you go for early morning walks and making sure that they have their product. But you're right. I mean, they've really made inroads. Does that actually take a bite out of Nike earnings?
I can't run first thing in the morning.
Can you?
Just can't do that.
I actually, that's how I wake up.
Credit to them.
I see Hocus
I do it.
I know you do.
So what about credit to me?
It just gets cold. Credit to you. That's right. You want credit to you, so credit as well. Credit to you.
I'm not running in the morning.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Alphabet is said to have restarted talks to buy cloud security company Wiz for $33 billion. The deal could be announced as early as today, and it would be Alphabet's biggest acquisition to date. Wiz would boost Google Cloud cybersecurity offerings, help it compete against Amazon and Microsoft. NVIDIA's Jensen Huang is set to speak at the chipmakers AI conference today at 1 p.m. Eastern. Huang is likely to comment on Blackwell, gross margins, China competition, and growth. Shareholders are hoping that Huang can inject some tech optimism and momentum back into the stock after an 11% decline so far this year. In sports, Argentina will be without its best player in its upcoming World Cup qualifiers. Leo Messi is dealing with a low-grade injury to his thigh and underwent an MRI on Monday. The 37-year-old's workload has become a key focus with both MLS and international play. The team did not give a timeline for his return. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, right-sizing expectations.
Know what you own, know why you own it, and have right-sized expectations. And like us, you might be pleasantly surprised.
It's as simple as that, apparently. Joining us next, Greg Tuorto of Goldman Sachs Asset Management, live from New York. This is Bloomberg. Equities just a little bit softer here. We're down 0.25% on the S&P 500. Some big downgrades to growth over the last month or so from JP Morgan, Goldman, Morgan Stanley, RBC. Now looking for just 1.6% GDP growth stateside this year and looking for GDP growth to stall in the first quarter.
Yeah, the downgrades just keep coming. RBC yesterday, UBS Global Wealth Management, Solita Marcelli saying that we see a 20% chance of a stagflationary market outcome caused in large part by the highly aggressive U.S. tariff policies. The downgrades just keep on piling down. Slower growth, potentially higher inflation.
A lot to consider going into the two-day meeting at the Federal Reserve. That meeting concludes tomorrow afternoon. And the surveillance this morning, right-sizing expectations.
The policy uncertainty takes us to say, well, this is just about what you would expect. That's quite natural. We think the way to weather it is with prudent diversification. It's not something that is indigestible. Know what you own, know why you own it, and have right-sized expectations. And like us, you might be pleasantly surprised.
So here's the latest this morning. US small caps looking to rebound from 2 consecutive months of declines as policy uncertainty weighs on markets. Greg Tuorto of Goldman Sachs writing, small caps are poised to outperform. They seem to be people's way to worry about a recession, and we think that's misplaced. Greg joins us now for more. Greg, good morning. Good to see you.
Good morning.
Let's start there. That's an interesting line. Why do you think that's misplaced?
Yeah, I think small caps since COVID have been people's, favorite play to worry about the economy, and I think it's because you've seen some different structures happen in fixed income, and I think in the domestic economy, even with some of these downgrades to growth that you referenced, there's still some pretty stable opportunities out there, and it may not be as good as we thought it was going to be going in, but I think it's going to be better, than kind of some of the downside predictions.
Certainly been anything but stable. So let's frame the last several months. Coming out of the election, boom. Let's go. November, great month. Then the weakness started to kick in. What started to go wrong?
Yeah, I think that there was a digestion period after such a strong month in November. I think that there was some worry about how some of these policies were going to kind of impact kind of the engines of growth that we had seen kind of in the economy, consumer being one of those areas that had done quite well in 2024. And I think that people were worried about how to place bets, and were we back to the Mag 7, or was it a broadening out type of environment?
At the same time, one of the reasons why people were excited about small caps for an immediate hot second right after Donald Trump was elected president was a combination of deregulation, a combination of the ongoing disinflation, and just generally U.S. exceptionalism continuing. All three of those pillars have been challenged in the past couple of months. Why is that not enough to challenge your assumption that small caps can really outperform?
Yeah, I do think that there is a kind of an underlying earnings story here that is kind of is the fundamental piece that doesn't get kind of brought into those top down type things. So the bottom up story is better than the top down. I think that that's one area. I think the other piece of it is that there's been a kind of a dearth of M&A for a few months, and I think we saw a nice big splash of that in January. A little bit more today, with what's happening with Alphabet on the cybersecurity front. And I do think that private equity, along with some of these strategics, could come in, and that could be another valuation dynamic which can meet that fundamental earnings picture, which makes things get better.
That pillar is also getting challenged. So let's talk about it. We were just talking about Capital One and Discover, and this idea that it could be stymied by the Federal Trade Commission, even though a lot of people thought this would be the administration that embraced a lot of the financial deals that people said would be in the pipeline. How do you take that? Let's say this is true. It is a report that is unconfirmed. How do you take that with respect to this administration's willingness to allow a lot of these deals to go through?
I think there are some areas within M&A that are third rail, and that's one of them, credit cards. But I do think if you kind of go into the other side of financials, you see a lot of small banks that are really looking to consolidate. We do think small banks and mid-sized banks will have a lot of consolidation. I do think that many of these companies are in better shape than they were, back 2 years ago, right? March of 2023, the Silicon Valley days, and I think you have a lot of these companies that are looking for either exits from management teams or for kind of growth opportunities in areas. I do think tech as an area, you've seen a lot more M&A in tech than in past years. You didn't see a lot last year. You saw a little bit in the beginning of the year. You're starting to see some now. I do think that helps. Healthcare is an area, I think, that you had 2 years where nobody did anything in healthcare other than a couple of biotech deals. MedTech, you saw a sizable MedTech deal earlier in the year. I do think that that's an area impacted by GLP-1s. I do think that that's an area where you can start to see some big opportunities being created as some companies look to kind of the inorganic pace of growth, to kind of help out some of the tailwinds that they need.
Credit cards maybe are the third rail, but when it comes to tech, the synergies are pretty much the same when it comes to the Biden administration, Trump 1.0 and 2.0 on how they view tech getting too big and antitrust and their concerns. So what kind of tech deals do you think could actually get through?
Well, that's the good part about being in small caps. We're below that radar screen, and we can stay away from those things. I think cybersecurity, like we saw, is an area that I think you'll see both private equity and strategics go after. I also think that some of these AI application companies that where you're seeing AI being used as a revenue source, not just something that's out there that's people are talking about. That's an area. I think semiconductors, which you're starting to see some of these companies start to think about what does my picture of my growth rate look like, in a non-CHIPS Act environment or in a more nationalistic environment. Some companies are stronger, some companies could be weaker. I think that's an area, especially in domestic production, which you can stay away from some of those FTC type issues. And I think that those are kind of away from some of those really big picture problems that people worry about.
Big picture problem right now is that US equities seem to be out of vogue and might be for a while. How challenging is that for you and the team?
It's not fun, but I can tell you that, I think that there's a, kind of a broadening out that's happened over the last 2 days that feels a little bit more normal, and it's 2 days, and you take each day at a time. That feels like you're starting to see some things that have worked. Energy has been positive for a couple of days. I mean, energy has been weak for a very, very long period of time. And if people are going to come back into those areas, you may think that there's a, there's been an opportunity that's been created that people may start to think about, kind of coming back into U.S. equities. We were so heavily overweight U.S. equities back in January. I think that was something that happened. You look at some of the people who look at flows, things are really, really over their skids. The VIX was really low. We're kind of inverted now, so maybe it's an opportunity.
So you put it as more of a momentum trade and more of a valuation issue rather than some sort of structural shift with flows out of the United States and towards Europe, correct?
I think so. And I think that if you go back to December, January, nobody would have bet on, kind of Europe leading the kind of the scorecards in terms of what had happened out there. You've changed things so quickly. I do think things have to come back into balance. Things aren't as bad as we've seen over the last 2 months. Maybe they weren't as good as they were back in November and December, but it doesn't, this shock, kind of loss we've seen in some of the U.S. equities, it seems a bit overdone.
The Tower was definitely at the World Economic Forum in Davos, Switzerland. I have never seen people so enthusiastic, the U.S. economy, and so pessimistic European markets.
Yeah, and peak pessimism. Who was that who said they always want to invest in peak pessimism of central bankers because that means that they probably have the markets back? Look, what I'm looking at right now is a lot of optimism about Europe and a lot of quickly moving pessimism about the United States. And what Greg just said there, I think, is the sort of contrarian take at this point,
narrative
which is
follows price, right? Yeah. So when you start to think about that, it builds upon itself.
It's flipped so quickly in just a few months.
Well, it's a good point that you bring up Davos, because isn't the thinking, whatever is consensus at Davos, do the exact opposite?
Yes, and if you did that, you'd made a lot of money over the last month or so. Greg, it's good to see you.
Thanks for having me.
Thanks for dropping by. Appreciate it. Greg Tuorto there of Goldman Sachs Asset Management with some things to think about regarding small caps. In the next hour of Bloomberg Surveillance, we'll catch up with Brent Schutte of Northwestern Mutual, Pierre Ferragu of New Street Research talking NVIDIA and a whole lot more. Stephanie Roth of Wolfe Research, James Camp of Eagle Asset Management on day one of a two-day meeting for the Federal Reserve. Equity futures on the S&P just a little bit softer, down 0.2%. In the bond market, yields just a little bit higher, up 2 basis points. Your 10-year 4.32. The third hour of Bloomberg Surveillance up next.
We've wiped away some of the post-election euphoria. People are tamping that down.
Investors globally have got to take more balance. That probably means lightening up on U.S. exposure and broadening out to the rest of the world.
The administration has greater tolerance for a move lower in the market and even a full slowdown in the economy.
It's going to seem loud. It's going to be a lot in the headline news. But for the long run, we will get through this.
There's this really negative narrative around tariffs. I promise you it'll change as we get into the summer months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Things are a little bit quieter, just a touch. We'll see if it sticks, we'll see if it holds. Equity futures going into the opening bell 90 minutes away, negative by 0.2%. Not a big move. On the Nasdaq 100 down by 0.4 over the previous 2 days. A sizable move, a gain of almost 3% on the S&P 500, the best two-day pop on the S&P of the year so far. Coming up later, down in Washington, D.C., the FOMC getting together for a two-day meeting. That meeting concludes tomorrow. It's a three-part act, a decision. We don't expect any change. A news conference, Chairman Powell in the spotlight. And I will say this, the forecast could be the main event. They could be absolutely fascinating.
They could potentially price in either fewer rate cuts for the remainder of this year or more rate cuts if they are going to emphasize the slower growth profile. That is where we will get the messaging, essentially, for how they continue to view the trade policy that they now cannot shunt completely out of the conversation. We have some elements of this trade plan, and they have to address not only what's taking place in Washington, D.C., but at companies around the country.
Professional forecasters have responded to this. On Wall Street, some of the biggest banks have downgraded U.S. growth. We've seen some real companies come out and say in the middle of February, we started to see consumer spending stall. I'm thinking of Delta Airlines. We've seen several big banks over the last week or so downgrade their outlook for U.S. equities, including Goldman Sachs, including the likes of Lori Calvasina at RBC.
Talking about bringing down her estimate to 6,200, about a 6% drop from the original 6,600 on these potential stagflationary types of wins. The other big question here is how much of this is coming at the expense of the U.S. for money to go elsewhere, like to Europe. I mean, ultimately, how much is this a flow story where maybe exceptionalism is moving? Because everybody's exceptional. Everyone can be exceptional as long as they put the fiscal spending behind it.
So by definition, no one is? Is that the way you're thinking about this?
You get a prize.
Do you want to get super philosophical about this?
Yeah, exactly.
Okay. Sentiment shift. Let's talk about that. A monster one. And when we're talking about that, we're thinking about money moving from the United States to Europe. The push for peace in Ukraine is a piece of that bigger puzzle. There will be a bigger push later on this morning.
Right. As soon as 9 a.m., potentially that call is set to begin. And what we could see here is closer to peace in Ukraine. Yesterday, Caroline Leavitt, the president's press secretary, said they're on the 10th yard line. But there's caveats to this. Our reporting already shows that Putin is coming in with incredibly high demands that Ukraine definitely might not accept, but even this administration might not be willing to accept. You have to think, is this just maximalist for Putin, or is he not going to budge?
The euro just about unchanged going into that conversation later on this morning. Equity futures this morning softer by a third of 1%. Coming up this hour, we'll catch up with Brent Schutte of Northwestern Mutual, with stocks eyeing a three-day rebound. Pierre Ferragu of New Street Research on Nvidia's biggest event of the year, and Stephanie Roth of Wolfe Research looking ahead to tomorrow's Fed decision. We begin this hour with stocks lower after notching 2 days of gains. Brent Schutte of Northwestern Mutual writing, we continue to see volatile days ahead. But here's the good news. Other parts of the market offer opportunities for patient, long-term investors. Brent joins us now for more. Brent, welcome to the program, sir. It is not even a month since we saw all-time highs on the S&P 500. I believe it was Feb 19th. That was something like 7 or 8 percentage points ago. Brent, a lot's changed, and it's happened fantastically fast. What's behind it?
Just the uncertainty that's out there. And as you've mentioned before, the different flows to different parts of the market where investors were way underinvested. And so I've heard a lot of the conversation this morning about how flows have already moved towards Europe. Look, you're talking to professional investors. I talk to retail investors, and there is still a belief that U.S. exceptionalism will last forever. And this is where I think there's still opportunities for those who believe in diversification to continue to move money towards other parts of the market that are cheap. Valuation doesn't matter on the upside. It does on the downside. And that's where I think you're starting to see investors thinking more about valuation and moving more towards these cheaper asset classes, which now have a catalyst in the form of debt spending in Europe. And so that's where we think there are opportunities pushing forward. That being said, certainly the next few weeks, the next few months are up for grabs just a bit. And that's where we want to caution investors to be on the lookout for more volatility.
So, Brent, it sounds like from your standpoint that maybe these gains in Europe, and they're big gains, more than 20% on the DAX so far this year, maybe we're just getting started.
Yes. Look, I think there's a trend change that's out there, and every economic cycle has different leaderships. And usually an economic cycle ends with a recession. We'll see about that. But there is certainly a trend change that is going on, driven by what's happening in the U.S. And that's where investors, I think, are still way over allocated and still trying to buy what has worked the past couple of years, which I don't think the path forward is in those asset classes. And that's why I encourage people, despite the narrative and despite the discussion you just had, U.S. small caps and mid caps are cheap. relative to large caps, the same as they were in 98, 99, which ushered in a period of outperformance. International markets are cheap. I think currency is going to be a tailwind, not a headwind. And so I want investors to go back to the good old way of managing money, which is diversification. And perhaps, may I offer, that we're in a golden era of diversification.
So this raises this question of what's cheap and what is diversification at a time when you have the main indexes that are so dominated by big tech that have absolutely gotten pummeled. Or basically you saying that we should just lean into the trades that have worked so far this year, go into some of the equal weight, go into Europe, and that actually has legs? Or are you saying that potentially at some point even big tech could become cheap?
No, I think the former. I think you want to lean into the things that have worked this year because they still are cheap. And they have catalysts now for them to advance in the future, which is where they haven't had much the past few years. I mean, cheap asset classes need a catalyst. I think they actually have that. And that's where investors are still underinvested. And that's where I think there's opportunities pushing forward.
Are bonds cheap? Are they a diversifier?
I think right now, if you think about the Trump put, it's probably out of the money. If you think about the Fed put, we're going to find out if it's out of the money. I think it should be. If not, then we'll see about that. But right now, the one thing I can tell you about fixed income and longer term bonds is they are hedging equity downside risk. And that's because I think people are thinking about an economic slowdown, even though they won't mention it too often, just because it hasn't worked in the past. That's where I think right now, I think you want to own longer, higher quality bonds in the event the economic downside does broaden out just a bit.
So I keep thinking about what Tom Becker of BlackRock said earlier on the program. He was talking about how everyone's becoming exceptional, how you have fiscal spending everywhere. You have European fiscal spending, you've got Chinese fiscal spending, and probably in the United States later this year, we will see another round of fiscal expansion of some sort or another. At what point does that concern you on the flip side, the idea that you could end up with structurally higher yields and higher inflation that really reduce that mitigating feature?
I think that's a current concern for the next 6 to 9 months, because I think eventually whatever austerity that we're going to have, I think that probably ends at some point, as you're mentioning. And that's where I do think the way out of this, because there is quite a bit of debt around the globe, is still through inflation. But I think that's off in the future somewhere. And I think for the here and now, you want to own longer term bonds, because I do think there is still economic risk to the downside of an economy that was already bifurcated coming into this. I mean, we have parts of the economy that haven't worked for the past couple of years. That's why the market's been so narrow. If you think about our positioning, and Lisa, you kind of went through some of our trades, small and mid cap, equal weighted S&P, all we're positioned for is the broadening of the market. It's been incredibly narrow the past couple of years, and I don't think that can continue. How that occurs is less important to me than it actually occurring. And I think if you look historically, when you've had this narrow of markets, that's what's happened on the other side. And I don't think this time will be any different.
Brent, you mentioned the Fed put. Is the Trump put dead?
I don't know that it's dead, but I don't know how he backs away right now from what he's looking to do. And so we'll see on April 2nd. That's where I think it's just further out of the money. I think that had to occur because everybody thought it was a negotiation tactic. And for me to believe that a negotiation can be successful, you have to believe that you'll follow through with it. And I think most people thought that he would back away when the market fell, and that has not been the case. I do think the bigger question, back to Lisa's inflation question, and something I'll be listening for in the press conference, given the fact that both sides of the Fed mandate are at risk, which side do they err upon the side of? If it's more along the growth side, with inflation expectations where they're at, with inflation still where it's at, then perhaps my comments on longer bonds need to be revisited. But for right now, I think at least my base case is that they will kill the inflation if they have to.
Well, when it comes to inflation and the potential concern around tariffs, what are you expecting the Fed to say? Because, yes, we're waiting for April 2nd, but at the same time, 20% tariffs have gone on Chinese imports and 25% on aluminum and steel.
I think they're going to try to say nothing new. We'll see if that's where the press conferences become incredibly important, because that's where the opportunity for a slip up are. To me, they're going to keep it kind of status quo, talk about the outlook, shifting just a bit where economic growth has slowed. They'll probably talk about that being more in soft data. They may even make the comment, which I kind of disagree with, that inflation expectations remain well anchored, which I don't think that they do. But that's where I think it's going to be a lot of, can we get out of here without doing any harm and see what happens next type of a meeting.
If that's the objective, do you think that harm is all but guaranteed, Brent? Because they could come across as incredibly blasé at a time where we can all see downside risk accumulating.
If I listen to your show every morning and I hear a lot of people come on this show, I do think there's the belief that the Fed will pivot and save the day no matter what, which to me probably ties into your question. that I think if they don't offer that up during the press conference or during the meeting, that may be a little bit of a disappointment to some investors who have learned for the past 15 years to bank on the Fed to be there whenever they have to be. And that's where I don't think they're going to be as quickly as they were in the past, just because of the changing dynamics. And that's where I think you need to rely upon diversification, not Fed or Trump puts to bail you out of markets.
I'm with you, Brent. I still think it's what a lot of people are looking for tomorrow afternoon. We'll see if we get it. Brent Schutte does not think you will. Brent Schutte of Northwestern Mutual. Thank you, sir. The pain tolerance of the Trump administration, let's sit on that for a minute. It's almost as if we've forgotten what happened back in 2018. We had an ugly, ugly period for markets back in 2018, and not just equities, high yield. That December of 2018, and the Fed had a role in all of that, I know. That wasn't just about the Trump trade and what was happening with trade. It was about the Federal Reserve. But at that time, you remember, we had something like a 100 basis point widening of high yield spreads in the month of December alone. I remember the primary market, you do too, it completely seized up. No issuance whatsoever from junk issuers that month. They can take a lot of pain. They've shown that in the past. This isn't a major change from what we saw back in 18.
And if you look at some of the recent reporting out of the New York Times, they indicated that President Trump's attitude is if the market really determined political popularity, then President Biden would still be president. And that actually, if it really did determine how people felt on Main Street, we would be dealing with a very different political reality than the one where a lot of people were clamoring for change.
Equity futures right now on the S&P, negative by 1/3%. Lots to talk about. A Federal Reserve meeting concluding tomorrow. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. NASDAQ is planning to open a regional headquarters in Dallas later this year. The location will reportedly house parts of NASDAQ's technology and financial crime management business. It's the latest push by a New York firm into Texas, which is trying to unseat the Northeast as the epicenter of U.S. business. Elsewhere, Harvard University is giving free tuition for students whose families earn $200,000 or less. That means about 86% of Americans would qualify for Harvard financial aid. The program will start in the upcoming financial academic year. Undergraduate tuition is about $57,000 a year, with more than half of students receiving financial aid. Rory McIlroy has won his second Players' Championship title in a thrilling 3-hole playoff against J.J. Spaun. McIlroy hit a timely birdie on the 16th hole, which Spaun followed with a costly triple bogey into the water. The win marks his 28th PGA Tour victory, and it moves him past Phil Mickelson on the all-time PGA Tour earnings list. And that's your brief, John.
With his B game as well. Wasn't even playing as well as he possibly could. Impressive. Danny, thank you. More from Danny later on this morning. No one round here.
I know, I was just about to say, the point where John talks to himself. I love it.
John, on the way out of the office yesterday, won't even look at you because he's staring at his phone. He's like, the golf's on.
I'm not even going to try and talk to you about it, all right? Up next on the programme, The Morning Calls Plus. Pierre Ferragu of New Street Research with NVIDIA's AI conference underway. The conversation up next. The opening bound 1 hour and 14 minutes away. Equities going into that negative by 1/3%, coming off the back of 2 days of gains on the S&P 500. On the Nasdaq 100, we're softer by 0.5. That's the equity picture. Let's get you some morning calls. First up, Citi lowering its price target on FedEx to $317, noting investor sentiment is heavily skewed to the downside. That stock is down by 0.7%. Your second call from Evercore, raising its price target on Apple to $275, expecting consistent growth for the next several years. That stock just a touch softer, pretty much unchanged in the pre-market this morning. Finally, the stock to watch at the moment, RBC lowering its price target on Tesla to $320. The firm lowering its valuations for FSD and Robotaxi. That stock is down by another 3% so far this morning. Softy yesterday. Got news from BYD as well, that essentially they can charge these cars in like 5 minutes with some great range too. So big developments coming from elsewhere.
It's two prongs of attack when it comes to the valuation story of Tesla. On one hand, you've got this question of international purchasing ability, given the fact that there have been drop-offs, particularly in European sales of Teslas. But then the other, can they remain at the vanguard of technological advancement when you have a real competitive edge coming from China?
That stock has had a phenomenal run over the last several years. It's been cratering. through this month. We're down by another 3% this morning. Let's turn to another Mag 7 name. Let's talk about Nvidia. Shares slightly lower in the pre-market ahead of CEO Jensen Huang's keynote speech at the company's developer conference. We're down by 0.5%. Pierre Ferragu of New Street has a buy rating on the stock with a $200 price target. Pierre joins us now for more. Pierre, welcome to the show. We'll get to Tesla in just a moment. Let's start with Nvidia. What do you expect from Jensen Huang later on?
Well, from Jensen specifically this morning, I think the focus is going to be, as always, on the product roadmap. You know, what are the chips coming through? There has been like a fairly high amount of leaks, so we have good visibility. There is a Blackwell 300 that is going to start shipping towards the end of this year, whereas like the Blackwell 200 is shipping now. So you have this shrinking, time between product and the next generation Rubin products. And as always, what Jensen is going to do is going to showcase on this giant screen in front of like 15,000 people, like 25,000 people even probably this year, the scale of the data centers these chips are going to power. You remember last year he presented the NVL72. It was a shock to see like a single server with 72 GPUs, with 72 like $35,000 GPUs. And we expect this year that he's going to announce like the next stage of super large cluster for very high performance inference, the NVL 288. So with 288 GPUs that are going to cost even more than $35,000, and that's probably going to come with the B300 or the Rubin architecture.
Pierre, is that enough? And I say this at a time where people are worried about the potential blockades on NVIDIA selling chips to China, on questions about technological advancements made elsewhere, and frankly, a real existential questioning of just how much the big tech players can keep spending on chips without showing some real advancements that can move the needle.
Yes, you're totally right. This is what Jensen is going to talk about. But yesterday, during the first day of the conference, that's not what people were talking about at the cafe and in meeting rooms and in the corridors. People are talking a lot about China, of course, and like on two fronts, like this idea of a blockade, of course, that has been lingering now for years. But there's also the question of how China is contributing to AI developments. And one of the buzzwords this year in the show is distillation. How does this industry do well if Chinese players like DeepSeek can come in and produce a model that is 10 or 20 times more efficient for a similar performance to what has been developed in the US with like multi-billion-dollar data centers. So the focus is not so much on NVIDIA itself. Like, I think investors understand that NVIDIA has a very strong market position and will probably defend it, even if some of the clients are developing their own ASICs. But the question is more like people investing these now hundreds of billions of dollars in data centers, are they ever going to make a living if the Chinese can copy what they do relatively easily with smaller models? So that's really like the number one focus, I would say, of investors as much as industry practitioners on the fair today.
There's a question about whether this affects NVIDIA, but there's probably a bigger question about how this has ramifications for the likes of Apple and Tesla. We were just talking about if China truly is getting to a technologically advanced point where they can produce products that are competitive and even supersede the technological abilities of the United States products. Does that engage with a new paradigm, which not only threatens the sales of some of the Apple phones or Tesla cars in China, but more broadly, internationally, how does that affect the competitive landscape?
Yeah, it's not something new, to be completely honest. We could have had this conversation 40 years ago about train technology. We could have had this conversation 20 years ago about car technology. And today we have this conversation about electric car technology for Tesla, chip manufacturing, and chip design, and also algorithmic design and AI development. So China has always been like a very, very fierce competitor. I think the key change today is that in the past, China used to leverage US and Western technology in order to be a competitor in the technology sphere. So they having access to mostly like the manufacturing technology, the IP developed in the West. And now the West is kind of like throttling access to that technology. So it's very visible on manufacturing. The Chinese can't access like the most leading edge manufacturing tools, and they're lagging behind still very much so today. We see that now with chips, where the Chinese can't access like the most advanced chips NVIDIA is producing. And now the debate is how can we like protect our IP from the Chinese leveraging it to compete against us? And you know that in the terms and conditions of the use of ChatGPT, you can't use ChatGPT to develop a competitor to ChatGPT. And so now the question mark is, okay, can we enforce that kind of protection to protect Western-grown AI? So the way forward is that it's very, very difficult to know how things are going to evolve. It's a balancing act between keeping the market open, because of course, US and Western technology companies like to sell in China, and also limiting sales to China in order to prevent China from making progress. And it's, I just talked about the past 40 years. It's going to keep playing over the next 40 years, because for China to catch up on advanced chip manufacturing, for instance, we're talking about projects that are probably going to take decades. It's going to take decades for China to be able to develop their own tools and things like that. So we'll be here in a year from now still talking about it. It's not going to be an overnight change. That competition is mounting, and of course, what we see is the risk of polarization of the world. Like that's what we call in our research the silicon wall. This idea that if the West becomes more and more protective with their technology, and China is becoming more and more like driven towards developing independent and competing technology at all levels of the supply chain, then what you'll see potentially is like this market polarizing and China being dominant on their area of influence, and the West keeping China out of their area of dominance. That's really, one of the direction of evolution of the situation that you want to watch out for.
Pierre, it's wonderful to catch up with you. Next time you're on, we need to spend some more time on Tesla. Pierre Ferragu there of New Street Research talking about NVIDIA. Tesla, for Pierre Ferragu, still has a buy rating on the name, 465 price target. This is what Tom Naran of RBC is looking for now, 320. So a cut to his price target, lowering its valuations for FSD and robotaxi over at Tesla. Really difficult month for that car company.
Yeah, and so far it has been driven by sales overseas and sort of the political association of Elon Musk with Tesla. But the FSD portion is really interesting. And Tom Narayan, for him to downgrade that, it's also another fundamental hit to the potential valuation.
Stock is down by 3% in the pre-market. Up next on the programme, we'll talk about the economy with Stephanie Roth of Wolfe Research, and get to the bond market with James Camp of Eagle Asset Management as the Fed's two-day meeting kicks off in Washington, D.C. From New York, this is Bloomberg. The opening bout 60 minutes away. Equity futures right now negative by 0.2% on the S&P 500. On the Nasdaq 100, a little bit softer as well. We're down by 0.4%. With 1 hour until the cash open, let's get you some morning movers with Yahira Hecker. Say, Yahira.
Hi, John. We start with a big mover here, and that is Bakkt, cratering 36% in the pre-market. This is a crypto exchange and custody firm that just lost two of its biggest partners. Bank of America and Webull have decided not to renew agreements with the company. And on top of this bad news, the company is also delaying its annual report. Next up, we have shares of PepsiCo. Those are falling more than 1% after Barclays downgraded the stock, saying that PepsiCo's ability to re-rate higher depends on its U.S. snacking business. And right now, the analyst says there remains a heavy lift to shore up that segment of its business. And because of that and some macro uncertainties, they are taking a cautious stance on the stock for now. And last up, we have Li Auto. This is a Chinese EV maker listed here in the U.S. It could be getting a lift on that BYD news, but it also presented at NVIDIA's AI conference, unveiling a new autonomous driving framework that it says has human-like capabilities. And all eyes will stay on that conference, of course, with Jensen Huang set to speak later today. John?
The hits keep coming for Tesla, that's for sure. Yahara, thank you. Appreciate it. That's the latest on the stock front. The Fed's two-day meeting kicking off later on today. The rate decision coming tomorrow at 2 p.m. Eastern Time, followed by Chairman Powell's news conference a little bit after that, 2:30. Mike McKee, our economic and policy correspondent, joins us now for more. Mike, what's the big focus for you and everybody else going down to Washington tomorrow?
How fast they can get out of Washington after the meeting is probably the focus for the Fed at this point. With no news yet on the tariffs, there's not much they can do. So they're not going to change their monetary policy. They're not going to change their dot plot, and they're probably not going to change the economic survey very much at all at this point. We do have a couple of additional numbers this morning. Housing starts up 11.2% after falling 11.5% the month before. So that industry fairly flat at the moment. Building permits were down 1.2%. Then we get the import price index, and the import price index is up 0.4, with passenger fares rising 3.4%. That is one of the last inputs into PCE. PCE expected to come in higher at the end of the month. So another reason for the Fed to just stay on hold.
And get out of that meeting as soon as they can. Let's see if it's that easy. Mike, appreciate it, sir. Michael McKee there. We'll be down in Washington for us tomorrow afternoon in that news conference with Chairman Powell. Stephanie Roth of Wolfe Research joins us now. She says Washington is shaking up her economic forecast, writing, "We revised down our US growth forecast from 2.2% to 1.6% on the back of 3 surprises out of the White House: DOGE cuts, early tariff implementation, and economic uncertainty." Stephanie joins us now for more. Stephanie, good morning.
Good morning.
That is quite a cut to GDP growth from 2.2 to 1.6. Is the Federal Reserve easing in that world or standing pat?
In that world, they are, but they're not easing for good reasons. They're easing because growth is weakening, and then they have to respond. But that's not something that they're going to put into their forecasts right now. Our base case is that they're going to call for 2 cuts in their dot plot, and we'll try to get out of that meeting as quickly as possible, as you said.
How much can they really signal that they can provide some sort of ballast at a time when people think some sort of economic downturn that induces job loss has a sort of prolonged scarring effect on the economy?
I think they'll say what they typically say is they're going to respond to the data, and if the data weaken, then of course they're going to respond. But they can't really promise that much more in advance, especially because this is an environment where they're likely to take down their growth numbers tomorrow, but they're likely to take up their inflation numbers. So this is a really difficult environment for them because they're going to have to wait until unemployment rate starts to rise more materially for them to actually be able to cut, as opposed to the idea of them being able to cut because inflation is low.
You know, I'm always struck by sort of the mass moves on Wall Street. Everyone seems to be downgrading their growth expectation to the U.S. for the U.S. GDP over the past couple of weeks. And part of it is this belief that this uncertainty isn't going to go away and that tariffs are here to stay. Is there anything that could make you revise it back? Is there any kind of caveat to that you're waiting for?
Yeah, so the April 2nd deadline is a big one. So this is where we're expected to get the sectoral tariff information as well as reciprocal tariffs. Our base case is that he'll do something country by country and he won't incorporate a significant VAT. But if he does just that, then at least that's a positive sign. And if he doesn't do some significant thing on the sectoral side, then that provides a little bit less of a GDP headwind than we were forecasting. But base case is he's not going to go light on that day. He's been talking about tariffs in a big way. He wants to do the sectoral things. He believes that that's going to help U.S. manufacturing and wants some right-size trade from a country-by-country perspective and has been talking about VAT. If they incorporate VAT, that could be a 1.4% GDP headwind. In addition to all the sort of the negative numbers that we've talked about.
You think that April 2nd is a key risk event that investors aren't paying enough attention to. We have reporting that Jameson Greer, President Trump's new USTR chief, is trying to really drive the narrative when it comes to April 2nd. This is someone who is a thoughtful trade lawyer. He's pretty calm, cool, collective compared to some other individuals, let's say, in the Trump orbit. Does that make you more encouraged about what we can see?
I mean, I think it all comes down to what Trump wants to do. Trump believes that the tariffs are going to be beneficial. He's going to do what he wants to do. And if that means doing sectoral tariffs, which, fine, there's arguments to do it, and country by country, that's fair. But what we've gotten so far has been a substantial headwind on GDP. And that's fine if this is the direction of travel. It's just a negative GDP shock. And 1.6 growth is, if we end up with that, that would be a decent scenario, realistically.
At the end of the day, Trump will make the decision. It's an individual that's been speaking about tariffs since the 1980s, let alone before he entered politics. If that's the case, and it's such a hit to GDP, what does the Fed look like? The one-time inflationary shock of tariffs or actually growth slowing?
So back in 2018, if you look back to their teal book, they said there were two scenarios that they could go about this. One would be exactly what they did, was looking through the tariffs they ultimately cut because it hurt growth. Scenario two is where they have to hike and cause a recession. And the deciding factor between the two is inflation expectations. So this is going to be the main thing that they're going to be looking at, is if inflation expectations stay anchored. And as of now, it's a little bit mixed. Some of the surveys are showing them ticking up. Some of them are a little bit more noisy than others. So this is going to be the main thing. If inflation expectations and people feel okay about the inflation backdrop, then the Fed can look through it and ultimately cut as a result. If not, their plain threshold is going to be a lot higher in order to do so. The main driver of inflation expectations, at least over the long term, is past inflation. So this is different than where we were in 2018, because 2018, people didn't really remember inflation. Most investors didn't really experience it. This time is very different. Our inflation expectations over the past 10 years have been shaped over the COVID pandemic, where it's been a different backdrop. So expectations might react differently this time, plus the tariffs are likely to be a lot bigger.
So let's go through the SEP. Let's look at this, and if you can get the mic up, and hopefully that's up. Is that on? The mic's died, apparently. So Lisa,
okay. Well, you were talking about the statement of economic projections and whether they'll signal a greater willingness to look at the weakness in growth versus something that we have seen with inflation expectations. How much do you see sort of an increase in worries about inflation at the same time of potential weakness?
Yeah, so there's a couple things that are going to be interesting. One, what do they do with their GDP forecast for 2025? What do they do with inflation? What do they do with the Fed funds rate at the end of the year? So base case is they take down their GDP something like 1.8, take up inflation to something like 2.7. And then what we're going to look for is within the SEP, you're going to see the risks around growth and inflation. And they're both going to be to higher inflation and lower growth. So that's a backdrop where, it's a very tough situation for them. And right now, I think they're probably going to keep the two cuts and kind of see how this plays out. Ultimately, they'll probably be, forced to cut a little bit more than, what's in the dots.
I keep getting struck by what Tom Becker of BlackRock said, which I thought was really interesting. This idea that everyone's exceptional in this new era where fiscal spending is taking off in places like Europe and places like China, at the same time that, on the margins, fiscal restraint in the U.S., but not really later on, where you're going to get further fiscal expansion as well. How much are you looking at a structural shift upward in inflation globally that's going to also rebound on the United States in a new way with a lot of debt sloshing around and a lot of debt-financed funding?
You know what? If it all plays out the way we're sort of forecasting for this year, you're going to end up with a Fed funds rate that was lower than would otherwise be the case. That is, we have a material slowdown in the economy because, it's more about growth than inflation, and then you ultimately have lower rates as a result. So I don't necessarily believe in this big structural shift up in inflation. Temporarily, of course, because of tariffs and some of the fiscal. Perhaps you'll run slightly above 2%, but I don't think we're talking about anything 2.5% to 3%.
They're so stealthy here. New batteries in the mic pack. Not sure why that happened. Stephanie, I apologise. Had lots to ask. We'll save it for another time. Stephanie, appreciate it. Stephanie Roth there of Wolfe Research. I want to get back to Mike McKee. Mike McKee, we had some economic data moments ago. For people just tuning in, Canada, inflation, not something we usually talk about. Let's get to it. Big upside surprise.
Big upside surprise. Last month, inflation was up this is CPI inflation in Canada, just up 0.1%. This month, up 1.1%. However, there is an explanation. The federal government had a sales tax holiday through half of the month. And when that came off, that pushed the rest of the prices up. And of course, the hangover from the previous month kept part of it lower. So year over year, inflation comes in up 2.6%, would have been 3% without the sales tax holiday. The inflation problem in Canada, much like in the U.S., it's housing. But the Canadian central bank cut rates again last week, 7th time in a row. So they're going to have to think about it again now when they meet on April 16th.
Mike McKee, certain central banks, including Canada, Lisa mentioned this in the last week, have tackled the policy uncertainty head on. They've said what it could do to the economy, and they've signalled how they might respond to it. We've seen something similar from the ECB President Christine Lagarde. She's been able to talk about the data in a way that maybe Chairman Powell has not. We have seen a subtle shift from Powell, though, in the last month, where he's begun to talk about various issues with the policy and what it might mean for their policies going forward from now. Do you expect him to be even more transparent and blunt about things tomorrow afternoon?
I don't really, John, and the reason is the Fed is in what it considers a pretty good place at this point. They are somewhat divided over where neutral is, but they're not that far from it. And with inflation being a little bit higher on the PCE numbers coming in at the end of the month, they can justify just staying where they are and saying, we don't know what the impact of the tariffs is going to be. We can model out a lot of things, but we don't know what the impact is going to be because we're putting on these tariffs. Our economy is also a lot bigger than the other countries. So the Fed is probably going to just try to stay out of it as much as possible and then try to measure what happens, which is why you see markets pushing out any kind of a rate move until the fall.
Mike, appreciate it. Mike McKee breaking down the economic data out of Canada, what that might mean for that central bank. And the bigger picture tomorrow, Chairman Powell in that news conference. James Kemp of Eagle Asset Management joins us now for more. James, good morning. Good to see you.
Good morning, John. Good morning, everybody.
What are you expecting from the Fed chair tomorrow afternoon? Let's start there.
I think this is one of the more interesting moments for the Fed in my career. And I say that because I don't suspect Jerome Powell approves of policy. He had an economy that was moving at or close to potential before the events, post-election, post-inauguration, I should say. He had inflation trending the right way, and now he's got this uncertainty that he has to deal with. So I think what will be interesting about the news conference is, does he talk about things like independence? Does he talk about working with Treasury? You know, we've got a debt issuance calendar that's going to pick up here pretty aggressively, and there typically was a pretty good relationship between Treasury and the Fed. I suspect some of that is splintered, so I'm interested more in his context, more of the feel of his language. Probably nothing on the rate front, probably till May or June. You do have a window here where inflation is going to be better. It's going to be more benign prints for a month or two. So if they're inclined, they've got a May-June time frame. Thereafter, I think the inflation story is prohibitive.
So Secretary Bernstein sat in your seat. Let's talk about the debt market first. And we were interested at the time as to whether the Treasury would extend duration, issue more debt at the longer end of the curve. And one thing he said in his response was that he didn't want to compete with the Federal Reserve, who was still engaged in QT. What happens with QT?
I think it slows. I think there's a realization that these tariffs are going to slow growth. Perhaps we already had a negative print because of the import-export. I think Bissett is absolutely the key to this administration. And how he behaves and how he manages the debt, which is increasing, will continue to increase despite what I would call performative measures in headcount. And he is going to have to structure the term structure of interest rates so that we can absorb both domestically and internationally a heavy debt burden. So I look at him as key. I feel, these are opinions of mine, that he's been stilted and awkward in his responses. I think it's an uncomfortable place to be a Treasury Secretary juxtaposed against policy right now.
To John's point, some people have speculated that we could get an announcement of a slowing of quantitative tightening at this week's meeting, possibly as soon as tomorrow. If they don't signal some sort of wrapping up or ending of that program where they allow treasuries to roll off and not repurchase them, do you think that will be a signal that they're at odds in some ways with the Treasury Department?
Absolutely. And I think that's a great insight, Lisa, because I do think you'll get some relaxation. But if that were not the case, it just adds to me to the long-term pressure on longer-term yields. I do think the Fed would like to see some slope in the curve. And let's just talk about what that means. The banks are underwater at the regional level. Loan growth in small business has been stymied because of the yield curve. I think the Fed ideally would be a 350 funds rate and a 450 10-year, but I don't think the events of the day are going to allow that kind of nice configuration to play out as theoretically we might see.
Which raises this issue of if the Fed were to cut rates in the near term, would that lead to another rise in long-term rates at a time when we have inflation ticking up in Canada, albeit for specific reasons having to do with the sales tax holiday being ended, but also fiscal spending around the world?
It's our belief that the long-term pressure on interest rates is to the higher side because of the issues that you espouse. It's our belief that inflation is structural, not transitory. I think we've proven that. We'll get through a couple of relatively easy months with the inflation print, but then it accelerates. It reaccelerates because of math, because of owner's equivalent rent, the other things that are died in the economic machine, if you will. And kind of like we talked about in September when I mentioned the 50 basis point cut, we kind of got that. It was maybe a little more fun than but the idea was there's going to be narrow windows for the Fed to normalize. The fall was one. This period is one, and thereafter, I think they're back to the inflation fight. And the policy moves of this administration don't quell the concerns of inflation. If you look around inflation means, they're anchored. If you look around inflation volatility and the deviations around those means, they're as wide as I've ever seen.
Is that because of tariffs?
It predated the tariff moves, but I think we don't know what this economy post-COVID really is going to look like. I think we're still wrestling with labor market dynamics. We're still wrestling with onshoring, nearshoring, supply chain. We're still wrestling and the unleashing of pricing power at the producer level. So what I tell clients about interest rates is unanchor yourself from the financial crisis to COVID. Just take that away. That's the moment in economic history that won't be relived. This is more normal. 2.5% inflation rate, a treasury rate with a 4.5% yield, income markets being more balanced relative to risk in equity markets. It feels abnormal because of the anchoring to the pre-COVID period.
I'd love to pick up on one point you made, performative cuts. Are you talking about, is that a translation for Elon Musk and Doge?
It is. And my belief, and I grew up in the D.C. area. I've seen the footprint. I know what's happened in the Washington area. But head count doesn't get us there. It's just math.
But do you think they're making it more efficient?
No. Categorically, no. Efficiency requires work. Efficiency requires what Bill Clinton did with Congress in the 80s, where you cut 170,000 jobs, but you did it judiciously. This is getting attention. There are probably agencies that had a political disagreement with the administration, but if you just do the math of 10% of the federal workforce and you give them $100,000 jobs, you got $23 billion in savings. We've got multi-trillion-dollar debts.
We've got a lot of work to do, that's for sure. James, appreciate your time, sir. To break it down, James Camp there of Eagle Asset Management. We've got to talk about a big deal in the tech world as well. Let's get to your Bloomberg brief with Danny Berger for more. Hey, Danny.
Yeah, breaking news on that deal. It is official, John. Alphabet is buying cloud security company Wiz for $32 billion in an all-cash deal. It is Alphabet's biggest acquisition to date. Wiz will help boost Google Cloud security offerings and help it compete against Amazon and Microsoft. Elsewhere, President Trump has promised to overhaul the Kennedy Center and accused prior leadership of improper spending. Trump said that the center will host Les Mis instead of Hamilton, which he said he never liked anyway. The president plans to ask Congress for additional funding to, quote, save this structure. And after 9 long months in space, 2 NASA astronauts are finally heading home. Butch Wilmore and Suni Williams departed the International Space Station aboard a SpaceX Dragon capsule at 1:05 a.m. ET. That started a 17-hour trip to Earth. The astronauts are due to splash down along the Florida coast around 6 o'clock this evening. That's your Bloomberg brief. John.
Hey, Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead and get you the latest on that big tech deal from Alphabet. Live from New York City, this is Bloomberg. The opening about 38 minutes away, with equities declining 1/3% on the S&P, down 0.5% on the Nasdaq 100. Your trading diary looks like this. Interesting couple of days coming up this morning. President Trump speaking with Russian President Vladimir Putin overnight. A BOJ rate decision tomorrow at 2 p.m. Eastern. The Fed rate decision followed by Sherman Powell news conference. On Thursday, it's the Bank of England's turn. Plus, we'll get another round of jobless claims and another read on consumer spending with earnings from Nike and FedEx after the closing bell. That call set to take place a little bit later this morning, potentially in the next 10 minutes or so. Bloomberg's Tyler Kendall joins us now from the White House with more. Tyler, set it up. What are you looking for over the next few hours from this phone call?
Well, John, I actually had the chance to catch up with Treasury Secretary Scott Bessent here on the White House North Lawn last hour, and I asked him how the U.S. is using its economic might going into this call when it comes to sanctions and potentially opening up Western financial markets. And he said at this point it is all, quote, path dependent. That is how high stakes this call is going to be. He told another media outlet in an interview this morning that President Trump has authorized him to ramp up sanctions from a level 6 to a level 10 if that's what it would take to get Russia to the negotiating table. Our Bloomberg News reporting that Russia could slow roll these negotiations after a headline broke this morning that Putin is looking for all military weapon flows to halt going into the country. Sources familiar tell Bloomberg News that at a minimum, Putin would like to see the U.S. stop those weapon flows. It remains to be seen if that's something that this White House would commit to after just last week it lifted its own halt on military assistance and intelligence sharing to Ukraine after they did agree to that 30-day ceasefire.
Tyler, thank you. Tyler Kendall in Washington on a phone call set to take place between the Russian and U.S. leaders. Later on this morning, we also want Washington's reaction to this one. Announced just moments ago, widely expected, reported overnight, dropped 24 minutes ago, that Alphabet has agreed to acquire cybersecurity firm Wiz Inc. for $32 billion in an all-cash deal. Where will Washington stand on that one?
Well, it's a good question, right? Because what have we been hearing? That this administration is kind of following the same tact as we saw from the previous administration when it comes to making sure that big tech is really working within guardrails and there's no concerns on antitrust. But potentially, this looked like this might actually go through. I think the deal is there, but it really depends on if there's going to be any antitrust concerns.
Number 3 player, I believe, in the cloud business. They've got Amazon and Microsoft in front of them. I imagine that's the argument they're going to make as the number 3 player, that we've got to compete with the other two when the other two are bigger than us. Whether that works in Washington, I've got no idea what works in Washington.
We've gotten conflicting signals. To put in some numbers on this, it's $32 billion in cash, as you said. It would potentially join the Google Cloud business and it would give those cybersecurity tools to customers to try to compete better with rivals. Question about what kind of antitrust business they're trying to prevent, right? It's one thing to say there are other cloud providers. It's another thing to say that they're going to own the cybersecurity world in a way that they wouldn't otherwise be able to. So this is an interesting moment and the first inorganic deal that Google has done in a long time.
Caroline Hyde and the Bloomberg technology team on top of the story later on this morning, of course, I believe at about 11 o'clock Eastern time. Later this morning on Bloomberg TV, Alphabet shares in a pre-market, not doing much, negative by 0.06%. Tomorrow, it's all about one thing. It's the Federal Reserve, and our lineup looks like this. Sebastian Page of T. Rowe Price. We'll speak to Mohammed Al-Aaron of Queen's College, Cambridge, the former Kansas City Fed President Esther George, Gargi Chowdhury of BlackRock, and a whole lot more. And special coverage of that Fed decision starts at about 1:30 Eastern time tomorrow afternoon. The decision's at 2, the news conference 30 minutes later.
Which might be the most interesting part when you have to hear Jay Powell respond to plans that actually are out there. He can't just say, we don't know what the plans are. The plans are available to us to some degree. So how does he parse that inflation versus growth?
The plans are fluid. The policy's volatile. I don't know what's going to happen.
Is that what you're going to say? You're channeling Jay Powell?
I've got no idea what
do you think the market would do if you did that?
This is what I think.
Fluid.
Good luck. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.